The next phase is about far more than growth. It's about strengthening investor trust, fostering responsible innovation, and ensuring that wealth creation reaches every corner of the country. Over the course of this summit, we'll be hearing from policymakers shaping the regulatory landscape, industry leaders driving the next phase of innovation, and investment experts helping decode the opportunities and challenges that lie ahead. But before we begin, we'd like to thank our partners, presenting partner HDFC Mutual Fund, co-presenting partner BlackRock, powered by partner Axis Mutual Fund, event partners Tata Mutual Fund, Motilal Oswal, ITI Mutual Fund, Trust Mutual Fund, and Edelweiss Mutual Fund, and an associate partner, Reliance Industries, for making this evening possible. So yes, let's gear up and let's take a huge round of applause before we begin this evening. All right, now it's time to officially commence the 5th edition of the Moneycontrol Mutual Fund Summit 2026 Mumbai. So ladies and gentlemen, please join me in welcoming Nalin Mehta, who's the Managing Editor, Moneycontrol, and Chief AI Officer, Editorial Operations, Network 18, to deliver the opening address and set the stage for an evening of thoughtful conversations on the future of wealth, investing, creation, and India's financial journey. Please welcome him with a huge round of applause.
Thank you, Lavisha, and a very good evening to all of you, ladies and gentlemen. The mutual fund industry, of course, is at the heart of India's retail investor boom, and I'm delighted to welcome you all to the 5th edition of the Moneycontrol Mutual Fund Summit. Now, at a time when global volatility has become the new normal, the ceasefire is on, it's not on, we see that every day. This year's summit theme, of course, from innovation to impact, seeks to unlock solutions in an era of AI and tech-enabled transformation and of volatility, looking for answers on how to scale up the industry from its current size of about 81.5 lakh crore of assets under management to its next big milestones and its next big phase of growth. Now, as the first choice for wealth creation for millions of investors, mutual funds occupy an exalted place in India's financial landscape. Despite the Iran war, Indians have continued to show their faith in SIPs, with monthly inflows remaining positive, roughly. And with India looking to reach its goal of Viksit Bharat by 2047, the mutual fund industry's role, therefore, is absolutely critical for wealth creation, for financial democratization, and for investor growth. The numbers, I think it's worth looking at the numbers to see how quickly Bharat's mutual fund industry has transformed India's personal finance story, turning us into a global mutual fund powerhouse. With over 83.4 lakh crore of average assets under management today, compared to 13.8 lakh crore in 2016, the industry has grown sixfold in the last 10 years. For comparison, the US mutual fund industry grew by about 8% in the same period. We have about 30,954 crores worth of SIPs coming in last month in May. That's about 16% more than inflows in May last year, so year-on-year growth, despite the Iran war. We now have over 10.4 crore SIP accounts and over 27.65 crore mutual fund folios. That's again about 18 or 19% more than last year. So the geography of India's investing is also changing drastically, with just about 1/5 of assets under management now coming from B30 cities. So going beyond the traditional centers, we are seeing huge growth of SIPs from states like Haryana, UP, Odisha. And we look at India's cities outside of the top 5, 86 out of 104 cities have been growing faster than the national average. Cities like Patna, Bilaspur, Gwalior, Thrissur, Ajmer being among the faster growing. So these numbers, I think, are a resounding vote of confidence in the industry. They're not just a validation of the mutual fund story, they're also a blessing. They mean that we now have a deepening pool of household savings that can power capital formation, support private enterprise, and fuel India's investment-driven growth. And yet, there are big challenges to reflect on. For example, the investor base may have hugely expanded, but only about 6 to 7% of Indians currently invest in mutual funds, roughly speaking, compared to, say, 50% of Americans. As a new generation of Indians becomes first-time investors and the industry scales up, there are key issues to reflect on. How do we build more trust in the system? How do you use technology to increase accessibility without compromising on transparency? How do we increase investor literacy so that every Indian understands the value of compounding, risk, and patience. Our panels today explore all of these themes and much more as we deliberate a blueprint for mutual fund growth in the time of AI and uncertainty. This evening, you will hear from the regulator shaping the framework. We have the executive director from SEBI here, and we'll be listening to you, sir, and to see what you say. Also in the room today, we have some of the industry's best minds, fund managers, investors, distributors, and policymakers to deliberate on what next and how to unlock the next phase of investor growth for Bharat. So tracking mutual funds and their trajectory is central to what we do at Moneycontrol. As India's leading business and markets news platform, we remain hugely bullish on the India story and strive to provide information that can help our readers make better investment decisions. This is why we are proud to have created this premier platform for key mutual fund industry stakeholders to come together to shape the industry's future agenda, to deliberate on key issues, and to spark off meaningful conversations, new connections, novel solutions, and long-term engagements that matter for Bharat. Thank you for being here, ladies and gentlemen, and for engaging with the money questions that matter to us all at the Moneycontrol Mutual Fund Summit. Thank you.
Thank you so much, Nalin sir, for those insightful and, of course, setting the stage for what lies ahead in this evening. But yes, let's move on and let's see how India's mutual fund folios has grown to about 27 crore. And yet, only about 5 crore people in a country of 140 crore are just active investors. Now, so the industry has grown overall, but the job is far done. SEBI is currently reviewing its entire mutual fund regulatory framework from scheme categorization to investor protection to ensure that this industry keeps pace with the investor it serves. Leading that effort is our keynote speaker. Please welcome with a huge round of applause, Executive Director of SEBI, Manoj Kumar.
Good evening, and thank you for inviting me here. I was listening to Dr. Nalin, am I right? So half of my speech was actually covered by him. I never realized that when you go to these type of forums, they are all data-based, and we were talking about AI, so probably AI is also playing the role. So most of the things you have already spoken, you have already covered the data point, and Madam also mentioned that there is certain work in progress, but let me tell you that here probably you are slightly wrong, because mutual fund regulations we have completely revamped. So that process is over. Categorization also we have done. So I am not sure that what type of audience is here, but if you notice that these are the two core development work which have been undertaken in last 1 year or so. And why these are important? Because probably it resonates with the theme of today's discussion, that how we visualize mutual fund industry in the next 10 years. So taking the industry to 10 years, abhi 85 lakhs crore, everything is over. Whenever I go to this type of forum, my ask is very simple, that in this country of 150 crores, can we take mutual fund industry to 50 crores investors? So generally, I don't get any answer. We are chasing our colleagues in AMC, we are chasing the distributors, so that whether in this 5-year period or 10-year period, can we reach that benchmark? We are searching for the answer. But from a regulatory side, we have done the groundwork. The entire regulations which were there for almost 3 decades, we revamped those regulations, and we have tried to make them simple. Some of you may say that regulatory things are never simple, but we have made an honest effort. And I am sure that going forward, when you see and when people will get more familiarized with the regulation, they will realize that a lot of ease of doing activities have been facilitated through the regulatory framework. And I can highlight 1 or 2 areas where we really focused. I will not touch on slightly disturbing segment with respect to TER, because AMCs are the sponsor of this program, so I don't want to disturb their apple cart. But yes, from a regulatory perspective, that was a very important change. But apart from that, there were many other significant changes which this entire regulatory revamp has established and created. The most important is that we have facilitated entities to do business. Earlier, there were certain structures prescribed in the law. We have completely opened up. Today, if you notice that any entity which is able to qualify and satisfy the eligibility criteria can be onboarded. Earlier, there were different concepts. Even going forward, you may see entities operating as an AMC without having a sponsor. So all these things have been facilitated. Why? Because probably we felt that there is a need for business to grow. And mutual fund, as Dr. Nalin mentioned, that it is a driving force. It has ensured that for last so many years, 38 years, as a regulator, we have been trying that how to increase the retail participation in the market, but it has never happened. Thankfully, to mutual fund industry, it has happened suddenly. And we are very proud of that it has happened through the mutual fund journey, and how to preserve this journey. From that orientation, the entire regulatory framework, revamped governance structures, we have taken a lot of care, because if somebody is entering into mutual fund arena, they should have some credentials and credibility, because that is the most important thing. But I must say that just because you have a credibility and you should run a mutual fund, that is also not the target. Objective is that you bring credible credentials, and on the basis of that, we will try to onboard you and try to give you a path where you can run a mutual fund business, because we don't want any disruption in the retail framework, because we believe that retail should continue and use this vehicle as a potential investment. Similarly, we have also tried that can we direct the industry towards MF Light framework. We have not succeeded. We did it because we thought that passive is the need of the hour, and everybody talks about passive. And I will come to you that from a regulatory perspective also, we believe that passive is the right way to be for the retail investor. But somehow that we have failed. In fact, not a single applicant has come in mutual fund segment where they have sought only a license for passive. We were thinking that many people will come, but it has not happened. We are analyzing that why this has not happened, and we will be very happy that some MF Light entity should come in our system and try to see that how they can expand the passive industry further. Similarly, we have also focused, which probably none of you have captured. Since I am standing on a platform of media, I may say very openly that one of the most significant change which we brought in the regulatory landscape for mutual fund was we have made an enabling provision for performance-based incentive structure, where mutual funds today, they are governed by TER broadly, but we have put an enabling clause where if you perform, you can earn. But none of the industry players nor the other related players, they have mentioned about that. In fact, today only one AMC who is also part of your sponsor category, they were sitting with me. So when we were chatting, I was wondering that how Brijesh has got the name of that entity, because we are not that porous where everything can come to our system. But they were also talking, and I was mentioning to them that Baki sab theek hai, why you are not focusing on this? So when we say that why you are not focusing on performance, then mostly we don't get any very proactive answer from any side. So but this is very significant, because going forward, when large number of retail players will come to the market, they will definitely expect that when you are giving them return as promised by you or as per their expectation, then only you should charge some fee, some performance-based fee, because that will help in developing a trust, because this entire industry is moving on trust only. We trust as a regulator the AMCs, and AMCs are trusted by the distributors and the investors. So everything moves with that trust framework, and I am sure that going forward, when more and more retail people, not only in Mumbai or metropolitan cities, but far off places come, then probably their expectations will be more. And they all will like to know from you that what is the simple return metrics, because everybody is interested in that. In the morning show, Anuj ji aate hain, ye bhi batate hain ki kitna return hoga, kya hoga. So everybody wants that only. So nobody wants to listen to your jargons and all. So I think all of us have to think that the next 10 years for this industry, what we should do so that this investor trust should be further enhanced. For that, we have done certain efforts. Like, for example, we are encouraging the industry that please go beyond 30 cities, travel to countryside. There is a lot of scope, because that helps us in resolving many regulatory issues, because all of you know that in far-off places, people are still very fancied by the assured returns, etc. And many Ponzi schemes, they function in those areas. So we believe that if mutual fund spreads its wing across the country, then these type of activities will come to an end, or we can control. So this is not only in regulatory interest, but in the interest of the industry also, that how to spread its wings across the country. And for that, I am sure that this entire distribution community, because this is a wonderful model, how the distributors have been structured in this country is something which all of us need to study. They have done a tremendous job in taking this industry to the investor, closer to the investor. And going forward, if all of us want to reach the countryside, probably more than physical efforts, we have to rely on digital. We were just sitting and chatting that what AI can do. Probably we believe that while AI helps us in doing many surveillance-related activities, which I will mention one or two, because we should not leave the dais before cautioning the people who are listening to us. But yes, of course, in terms of distribution, digital can play a tremendous role, because we cannot cover everybody just by physical presence. We need to have a very huge network of digital distribution. And I request all of you that when we assemble in this type of fora, we need to brainstorm on that how we can enhance that distribution network. If that happens, then I'm sure that the journey from 5 to 50 crore is easier. It will not take much time. But for last many years, we are sincerely trying. We have facilitated certain rules and regulations within the revamped framework also. But still, the amount of traction which we were expecting, we are not able to see. Similarly, when adoption of AI is concerned, as a regulator, probably we have done much adoption. Like, for example, we often share, probably many of you may be aware that we have developed an in-house capacity where we can detect the advertisement which is not in conformity with the mutual fund code which we have prescribed for the distributors. So today we have an in-house system which can immediately flag it to us, and we are in a position to take whatever appropriate action is warranted. And now, which we call it radar, and we are upgrading it. Some of you would have read that a new tool has been evolved, which is known as Sudarshan, which is capable of scanning 24/7 the entire ecosystem of websites which are placing influencer type of advertisements. And today we have a capacity where not only we can identify that, but from the back end, we can interact and use our resources to get it removed. So these are some of the areas where we are using AI in an extensive manner. Similarly, we want that all of you should scratch your brains and see that can we do it for distribution? Can we do it to make mutual fund more appealing to investors? Like when we were working on this categorization circular, we were struggling if our target is to go to far off places, how we can make the schemes simpler. Because even today, if you ask me, though I am working and associated with this department for many years, but still I struggle that what a particular scheme means. So if we can simplify the schemes and articulation, we can make it in a simpler fashion, probably those schemes will be better understood by the investor. And if schemes are understood by the investor, then chances of mis-selling are tremendously reduced. So while we have made an attempt through categorization, but I am sure that many of you may still say that a lot needs to be done in that categorization circular and framework. We are open to that. And Brijesh was asking for some news bite, so I can say, because he overheard some conversation which we were having, where he said that 24B is still surviving. So answer is 24B is still there. And those who are not familiar with 24B, it is very simple regulatory construct which allows existing entities to do certain other activities with certain restrictions. We believe that those are certain restrictions, but entities always feel that, no, this is not allowing us to operate. But yes, that's a work in progress. 24B as of now has become 21. So that is the only change which has happened fundamentally. But yes, lot needs to be done on that, and we are constantly interacting with the industry to see that we can make it more conducive so that entities are free to operate. Certain concessions we have given. We are further looking at what type of other concessions we can build into the regulation. Similarly, we are also working, though this is a mutual fund summit, but we are working very closely with the PMS industry. And why we are doing so is that they have very serious grievance with us that we are favoring mutual fund, and that's why SIF type of product we have parked in mutual fund. But idea of parking SIF with mutual fund was that we trust the governance structure of mutual fund as compared to the PMS. I'm not saying that they don't have a governance structure. They also have a very good governance structure. But as far as retail inclusion is concerned, our trust is more on mutual fund, and that's why we introduce SIF in mutual fund. But we are working very closely with PMS industry, and the entire regulatory setup also we are trying to revamp in the manner in which we have did for mutual fund regulations. And soon you will hear from us that a very revamped, industry-focused, investor-focused PMS regulation should be in place. Another area where we are focusing, and why I am articulating these points, is because we believe that whatever we are doing today, probably that may help us in taking this industry, entire fund industry forward. We are also very closely looking into the issue which is bothering the distributor. I understand that certain distributors are also here in this hall, so I should address their concern also. So we are working very closely with your associations to see that the conflict between you and investment advisor, how it can be addressed. Working group is almost at a final stages in giving its recommendation, and we believe that once the recommendation comes and we adopt, there will be a very harmonious construct between the two entities, because both are required in this country. Without each other, we believe that financial inclusion cannot happen at a pace or at a depth which we are expecting. Others issues are not very palatable because when we do a development work, we also focus on a lot of actions, and going forward, while we have completely revamped, we have given a lot of concessions in terms of institutional mechanisms, etc. But we believe that so far industry has helped us in monitoring things effectively. But going forward, there is a lot of demand from our side, and we will keep a very closer eye that once you expand that, then it should not happen that what is the desired objective of this entire mutual fund focus get diluted. So teams which are very closely assigned with mutual funds with certain alphabets, etc., and they are monitoring, and they keep on flagging issues. Our objective as of now is that we should be hand-holding the entire industry. See, if you do a business activity, it may happen that you would have committed some violation without intending to do so. So those type of issues and scenarios, we are very, very open, and we sit with the industry and try to convince them that why this particular compliance is necessary. Even where there are certain deviations, if you would have noticed of late, we are moving in a very softer fashion, and we are hand-holding the entity. We are sitting with them. Our teams are extensively discussing with them, so that we should encourage a compliance culture. I'm not at all suggesting that industry is not compliant. We are very happy industry is very, very compliant. But going forward, expectations are huge. And 10 years down the line, I don't know, number crunching only you people can do. We don't do number crunching. But yes, we believe that 10 years down the line, this entire mutual fund industry will become a shining example of other reforms which we have done over a period of time. When we were, some of you who are older into the securities market, if you recall, when as a regulator we tried to move all 18 regional exchanges to an electronic platform, we were criticized because it has never happened across the globe where so many exchanges have moved in an electronic environment. But thanks to the cooperation from all of you, we did it. Similarly, dematerialization, nobody imagined that in India we can do it so faster and so efficiently. And today, because of these developments, we are able to leverage on them. And what we are witnessing today in terms of mutual fund is a third revolution which is happening in the securities market. And we believe that this revolution will truly, truly inculcate the retail investor and investment habit in this country. With these words, I truly thank you that you have invited me. This is the 5th summit. Generally, regulators are not invited to these type of summits. These type of summits are meant for thought leaders. We are not often considered as thought leaders, but trust us that whatever outcome or whatever deliberations happen in this forum, surely we will get some wind of those outcomes, and we will definitely try to structure ourselves in terms of operation, in terms of creating regulations, and in terms of creating guidelines surrounding that. With these words, I am truly, truly grateful to all of you for giving me your time. Thank you very much.
Okay, thank you, Mr. Kumar, for an insightful start for this evening. And of course, quite a bit of measures and works that you have talked us through to strengthen the ecosystem. But requesting you, sir, to please come back on the stage, and we'll open the floor for just 2 to 3 questions for a bit. So please come on the stage. Since we have the regulator finally here, then why not?
I believe I was so exhaustive, probably questions are less, but still, yes, I would be very happy if you have questions.
Yeah, good evening, sir. Here.
Yeah.
Yeah, good evening, everyone. Yeah, I'm an investor as well as a distributor. So, I sit in the restaurant and operate in the kitchen also.
Right.
So now my question is, I don't know how to put it and how people would take it at this forum, but just one very simple question. We see celebrities on TV talking about mutual fund. Okay, so what authority do they have? I'm very straight, please don't mind it. But then distributors have a lot of compliances. They have to be very careful in choosing the words also. And we see celebrities openly talking about it. A lot of it, So, when the market is down, returns, all these words have been used,
So I have understood your question,
Yeah.
and it's a very good question, because recently we have issued a consultation paper surrounding that how celebrities can be used. Ab you call Anuj ji as celebrity, I have no problem, because he speaks about what will happen to the market, and that is their job. But what we have ensured is why so far we are very careful about introduction of celebrity. There is a constant demand from the industry that why industry cannot use. And not only from mutual fund industry. Mutual fund industry is lucky कि वो सही है कि बना दिया इन्होंने. ठीक है, that is, as an industry body, they have done a wonderful job, and it's a very good model which others should also study, that how without being an SRO they are able to drive the industry. So what they have done is tremendously nice, but if you read our recent consultation paper, what we are trying to do is we are trying to create certain guardrails where everybody should be allowed to do certain advertisement. Because as you rightly mentioned, it is a very gray area. Even we struggle at times that some complaint comes to us that this distributor has done this type of advertisement, in which category it falls. Then we have to do lot of groundwork कि इसको कहाँ fix करें. So this is a huge challenge. With this consultation which we are doing right now, we believe that sooner we will come out with the regulation which is more clearer, which will articulate in a very clear terms that who can use it, who should not use it, how to use it, when to use it. So all these issues will be addressed. That is my firm belief. So wait for some time, let consultation is over. Again, I will come to this forum and we will address this issue.
Thank you, sir.
Sir.
So I have one suggestion. So whatever mistakes happen in advertisement, etc., or the regular compliance by MFDs or AMCs, etc., if they can be put in a case study, because as you also mentioned, some mistakes can happen unknowingly. So if those can be put under case studies, it can be very helpful for compliance purpose.
Fantastic question, and you all will feel that paper is leaked to me. It is not. In last week only, we have, with MFI, we have done a small program in NISM where we have created 5 case studies surrounding how distribution mistakes happen and where is the thin line. And we have ventured out. I myself was there in that program. We have taken the practitioner from my team who are dealing with this type of challenges, and they explain to distributors that where is the thin line. Going forward, we will make it more extensive. We will ensure through MFI that we should cover all distributors in this country. So this is a very good question, and we are developing more case studies surrounding this. So far, we are able to develop 5, but if you have many more to suggest to us, we will be very happy to adopt.
We'll be very happy. And sir, so I always mention this as sales pitch to those people who don't have trust in mutual funds and the industry. कि जब ease of doing business रैंकिंग आती रही WTO की, तो उसमें एक पैरामीटर था, 12 पैरामीटर में से सेफगार्डिंग द इंटरेस्ट ऑफ माइनॉरिटी शेयर होल्डर्स, उसमें इंडिया की रैंक केवल 5 थी. So that's just a manifestation of all the great work that SEBI is doing, and we had a direct experience of such thing. We got PMS license some a year back, और छोटी सी फर्म है हमारी, फर्स्ट जनरेशन, नो बिग नेम नथिंग, और हमें PMS लाइसेंस 6 महीने में मिल गया विदाउट एनी डिफिकल्टी ऑन.
जल्दी मिला या देर से मिला?
नहीं सर, जल्दी मिला. मतलब जल्दी से मेरा मतलब ये है कि लेट मी एड्रेस द एलिफेंट इन द रूम. किसी ने घूस नहीं मांगी, किसी ने बदतमीजी से बात नहीं करी, The inspector who was looking after our file was very modest, very humble. जो भी हुआ उन्होंने सारे डॉक्यूमेंट्स अच्छे से चेक करे, और अगर हमारी जैसी एक छोटी फर्म को जिनका एक 800 स्क्वायर फीट का ऑफिस है, अगर उन्हें पीएमएस लाइसेंस मिला है विदाउट एनीथिंग एक्स्ट्रा, so that's a huge moment of pride for all of us, and thanks a lot for running such a great institute, sir.
थैंक यू वेरी मच. सो वो आप कह रहे थे बहुत सारा वाइट, ये है एक्चुअल वाइट. But PMS, going forward, you will see lot many changes. Even 6 months, according to us, is a long time. We will reduce this time frame further. We know, we understand the challenges. Problem with PMS is that there is a small player and a very large player. So we are trying to address that issue.
नहीं सर, मैं तो उल्टा कह रहा हूँ कि हमें प्रोसेस काफ़ी अच्छी लगी. काफ़ी तरीके से सब कुछ हुआ, सब कुछ वेल डिफाइंड था, और हमारा काम आसानी से हो गया.
Okay.
I think. Thank you.
Okay.
Thank you.
Okay, that's all the time we have for the Q&A. And thank you, sir. Thank you, sir. Sir, requesting you to please be on stage. We have a special timing and a moment right now. I mean, it's a time for a special moment because, passive investing, that continues to gain momentum in India. And, investor awareness has just become quite important as investor participation. To support that journey, Tata Mutual Fund has created Passive Ki Pathshala, which is a practical guide that simplifies the world of passive investing for every investor. So may I invite Hemant Kumar from Tata Mutual Fund to join Mr. Manoj Kumar for the official launch of Tata Mutual Fund Passive Ki Pathshala. Okay.
So, Dr. Nalin, Moneyfront, Manoj sir, always an enlightening speaker. Industry leaders, Navneet sir, my favorite, and friends. I think it's a great opportunity for us. Manoj sir ने पैसिव्स के बारे में बात ही की थी. मैं यहाँ पे खड़े रह के I can't tell you numbers कि total AUM का 18% पैसिव्स हो गया है. There are more than 300 schemes. It is growing at 25% CAGR. ये सब चीज़ें हमें पता हैं. What can we do to strengthen the core? हम enable कर सकते हैं और educate कर सकते हैं distributors and investors. So passives की पाठशाला is an initiative from Tata Mutual Fund in this direction. And I'm really hoping, and the point that Manoj sir made, कि 5 से 50 करोड़ की जर्नी करनी है. Some of these initiatives will help that journey and help distributors and investors gain better knowledge. Thank you so much.
Thank you, gentlemen, and of course.
So today I think everything is happening what I am desiring. Even passive I mentioned, so immediately some launch has happened. So very nice. Congratulations to you. Thank you. Thank you.
Thank you so much, sir. All right. Thank you, Hemant, and thank you, Manoj, sir, and of course for the book launch. Yes. Thank you. All right, and before we move on to the next set of conversation, let's take a quick look at the journey that showcases how conviction, consistency, and long-term investing can create meaningful wealth for investors. Here's a glimpse of HDFC Mid-Cap Fund's journey as it enters the 20th year with 1 lakh crore rupees OM milestone, delivering 17% CAGR since inception.
mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
All right, that was the AV for us. But yes, let's move on to our, conversations that will shape this evening. We'll first talk about how India is on course to become a $10 trillion economy by 2035. That's what the study by Center for Economics and Business Research has shown us. And we've seen that household financial savings that deepen, and India occupies a larger share of global investment portfolios. So the question is no longer whether growth will come, but how investors can participate in it. And can capital markets fund that journey? And are there investment opportunities that investors are still underestimating? So to explore this conversation, may I request Nalin sir to come back on the stage. And joining him is Navneet Manot, who's the MD and CEO of HDFC Mutual Fund. Let's welcome them with a huge round of applause.
Thanks very much, Lavisha. Navneet, pleasure to be here on the stage with you. And as we were talking just before we got in here, we are roughly at about 4 trillion as an economy now, depending on what the exchange rate of the day is. And every day we go up one rank or go back one rank. But to get to 10 trillion, say by 2035, in that time period, what are the 2 or 3 things that we must get right from where you sit?
First of all, thank you so much, Nalin, to you and Moneycontrol family for associating with us for this thought leadership event. This is the 5th one, and I really like the title this time, Innovation to Impact. And for us, where we are driven by a huge sense of mission, wealth creator for every Indian, the impact part is very important. And we were all inspired by Mr. Manoj Kumar when he said that we need to take the journey from 50 million investors to 500 million investors, and our industry is determined to move in that direction. I think in India, the biggest thing about going from 4 trillion to 10 trillion or then 20 and 40, it's not about moving from whatever we were 10th largest, now 5th largest, to 3rd and 2nd largest economy in the world. It's not about moving from $2,500 per capita to 5,000, 10,000, 15,000. It's not about India moving from 6th or 7th largest market cap nation to a 5th, 3rd or 2nd largest. I think the biggest differentiation about India's growth story with any other story in the history of humanity is that our growth will be democratic, sustainable, equitable, and inclusive. In one breath, you cannot talk about these 4 words for any country in the history which has gone from a frontier to an emerging to an emerged to a developed country. So India's journey from where we are today to a developed country to a $10 trillion plus economy will be democratic, sustainable, equitable, and inclusive. And that makes the biggest difference between us and anybody. We will not destroy the planet the way every other country which grew in this manner. We won't do to humanity or to the future generation, won't borrow so much from the future generation, which many other countries have done, and we are doing it in a highly inclusive manner. And particularly on the inclusion part, I think the financial inclusion is going to play a very, very big role in ensuring that in that the journey from 4 to 10, the fruits are shared with a larger number of people. The recent events in last couple of years, be it the COVID, where we faced like lots of challenges in terms of supply chain, whether it was the Russia-Ukraine crisis in 22, or the trade war and its implications on rest of the world, some of the technological changes which are happening. I think what we need to work on in next couple of years is what I call the 5C, where we become more Atmanirbhar. Number 1 is crude oil and natural gas. Second C is chips and semiconductors. Third C is critical minerals, chemicals, and fertilizers. Fourth C is components, from solar cells to auto to aircrafts. I think there are several components where we are hugely dependent on some or the other country or defense, where we need to get more Atmanirbharta. And last but not the least is the C is the capital. While the domestic mutual fund industry, thanks to support by the regulator, policymakers, and people like you and our distribution partners, we have really grown, where the SIP book has grown from 3,000 to 30,000 crores, 35, $40 billion of consistent supply of capital is giving stability to the market. But given the humongous investment need, this need to be taken to a much higher level. While the first 4C, the crude oil and natural gas, chips and semiconductors, critical minerals, chemicals and fertilizers, and fourth is the components where we need to get more Atmanirbhar and be less dependent on others. But on the capital, I think we need both. We need to mobilize more domestic savings and channelize them into productive investment on one side. But given our investment need, we'll need a lot more foreign capital going forward also. And for that, how do we increase the absorption capacity of the economy and create a conducive environment? And I've coined this term like inevitable India. How do we present ourselves to the rest of the world that for both talent as well as capital, how do we become the inevitable India that everybody would like to come?
So on that last point on foreign capital, we've seen a rough patch recently. We've seen FII outflows. We've seen a real issue there. So what would you like? What is your reading of it now, and what needs to change to get FII flows back into India in the way that we saw until a year ago?
I think people talk about the valuation, taxation, many other aspects, but in calendar year 23, they were net buyer. Calendar year 24, if I remember correctly, they were net buyer. But of course, if you look at a block of 5 years, foreign portfolio investors since 2021 would have sold like $38 billion. In the same period, domestic institutions like ours would have deployed like $270 billion. But as I said that, I think given our humongous investment needs, we'll need more foreign capital going forward. I think recently we have seen policymakers taking some measures on looking at the taxation on investments in the government bonds.
The G-Tech side.
Post that, we have seen the foreign investors investing. Maybe there is this whole AI trade, which is like, kind of like gobbling a large part of the global capital. At some stage, I'm sure people would find relative value in India. If we continue to remain on the path of reforms, if we continue to ensure that we deliver returns to the investors, I'm sure at some point in time, the foreign portfolio investors are likely to return on the equity side as well.
So you remain bullish on India?
In fact, there are two reasons for which over a 30-year period, their ownership went up from 0 to 24% of the market and almost half the free float. First was the structural macro and growth story. I mean, a predictable policy environment, democratic environment, rule of law, and a growth from a very low base. The second was a micro opportunity of stock picking, that India is a country where you get large number of high quality businesses run by very credible management, good governance, good disclosures, capital efficiency, so on and so forth. My view is that for a global investor, the third dimension that should make India more attractive than any time in history is the consistent flow of the domestic investors. Because what the SIP flows are doing is reducing the volatility of the market on a structural basis. So on a risk-return spectrum, I mean, if you look at the efficient frontier, the Indian markets should actually become more attractive because of that reason going forward.
So let me push you a little bit on that. On domestic investors, of course, they've been holding up the market for a while now, at a time when the FII flows were going out. So does that mean that the Indian markets have generally matured, which they have to some extent? Or are we just one big global shock away from finding out that it wasn't as durable as we thought?
So you said,
so I'm saying that with the domestic investors are the ones who've been holding up the market for a while now in ways that much more deeply than before. Now with the FII flows, outflows and so on, does that mean that the Indian market has matured a lot more? Or are we just one more big shock away from finding out that things are not as strong as it looked like? So what's your sense of this on the long-term sustainability of this?
I think industry has worked very hard. I think the reasons people ask me like, what has happened? Why, I mean, from 2 crore investors, we moved to 6 crore. Why the SIP book, which was 3,000 crores in 2016, has moved to 30,000 crores? I think the reasons are, I think it's a track record. I mean, we just talked about SDFC Midcap Fund, 20-year track record. We have a couple of funds like FlexiCap and All Balance Advantage, which have been in existence for 30 years. Investors can see, despite all the volatility and ups and downs, what returns they've given over a 30-year period, over a 25-year period. Number 2 is the transparency, and thanks to the regulator, we have made this product so transparent. The kind of disclosures we have, the way we have made this product so investor-friendly. The third is a technology which is playing a very big role in whether the investor education, investor onboarding, portfolio management, so on and so forth. And last but not the least, the training. I mean, just to create this acronym of 4T, the training is the investor education. And together, this has created increased trust among the investors. And I think to me, the journey has just begun. I look at the overall household balance sheet of $14 trillion. Only 6% is in equity, 50% is real estate, 15% is gold, 15% is deposits, remaining is insurance and provident fund. The equity allocation is still very small. I mean, you talked about $4 trillion economy, 20% household savings, $800 billion. In couple of years' time, and hear this number, in couple of years' time, annual household savings in India will surpass United States, the household, because their savings rate is lower on a larger size of the economy. Our household savings in the next decade, annual household savings will be higher than United States. And imagine what it has done in last 40 years, the 401k, what it has done in last 40 years to the US markets, and what SIP can do to Indian markets, Indian entrepreneurship, India's capital formation, and India's economic growth.
So, Navneet, there's been an entire generation of Indian investors who have only seen large periods of growth, right? And for whom these troughs that we are now seeing are absolutely new. So, from where you sit, you run the third largest fund in the country. Where do you sit? How do you see this?
So I must compliment and congratulate this generation. My grandfather lived in a country where India had to import wheat under PL 480 from United States on humanitarian ground. My father lived in a country where we were dependent on foreign grant for subsistence. I lived in a country where every entrepreneur of India had to go outside India to raise any kind of capital, whether as an angel funding or debt or equity. My son is living in a country where a Korean company is raising capital in India. We should be proud about it.
Let me ask you, I want to go back to the FII question. What will it take to get FIIs back in India? I mean, beyond the general stuff around the long-term India story, specific measures, if you could outline from where you sit, which you think will help FII flows back?
I wish it gets a little more media attention. I think the work that has been done by SEBI in last couple of quarters for the foreign portfolio investors, they demand on relaxation on the block window for large trade execution, they demand on closing auction, they demand on netting off settlement for the securities. They had to put like 1 day the extra funding, and easier onboarding. The 4 big demands from SEBI have been met. Of course, they also have a demand for favorable treatment on the taxation side, which I think, if I've heard the finance minister right, they are open to listen to any other demand from the foreign portfolio investors. Yeah.
So something you were saying about the household. So the share of equities in mutual funds in annual household financial savings has jumped from about 2% in FY12 to somewhere around 15% now. Bank deposits have shrunk in relative terms. So how central is this shift to this idea of building a $10 trillion economy? And what happens to the math if a long bear market shakes sort of investor confidence?
The transformation in India from a nation of savers to a nation of investors is not only an economic or financial trend, it is a social and cultural trend. For thousands of years, your retirement security was your kids, that your son or daughter will take care of you when you retire. Now the change in the demographics, the change in the society, the change in the culture is leading to, this is the first generation which is starting to feeling about, I need to create a financial freedom by investing in a disciplined manner. This I call the India's 401k movement, like 1980s in US. The mutual fund industry in US started in 1924 with MFS, but it took 50, 60 years for it to mature to a stage where people took faith that I can invest for a couple of decades during my accumulation phase, and over a period of time, I create my security. These are like very early days of financialization of savings in India. The other, which is, so we talk about the formalization of the economy, the digitalization of the economy, digitalization of finance, financialization of savings, are structurally very big trend. But another interesting trend is the financialization of assets. We have seen this in gold and silver ETFs. You are seeing that in REITs and InvITs. So the real assets, be it commodities, be it real estate, be it like commercial real estate, be it infrastructure assets, they also getting financialized and tokenized and fractionalized and owned by smaller people. These are like real big trend for the asset management industry, and this is just the beginning.
So the question that Mr. Manoj Kumar asked, which was 5 crore से 50 crore कैसे जाएंगे? What is your answer to that question?
No, sir, हम तो साथ में काम कर रहे हैं. So I had the honor of being the chair of MFI. Now board member Sandeep, our current chairman, is here. We work hand in hand with the regulator. When we travel outside India, you hear about how people kind of complain about their regulator. In our case, it's completely different. In our case, we take deep pride in the handholding by them, in the active guidance by them, in the active nudge by them. There are very few places where the regulator drives you to do more for excellence, for being so investor friendly. And I think several of the measures of SEBI has led to the growth of the industry. So our answer is that keep inspiring. We are determined, and together we want to be the wealth creator for every Indian.
So the SIP stoppage ratio, it crossed 100% in April, I understand, meaning more accounts shut than they opened. So it's eased to about 95% in May. Is this an early warning signal or just normal? What is it that you see in this trend?
I think we have worked very hard in MFI to ensure that the data that you are seeing, the two data, number one, the 30,000 crore amount which is coming, this is the money in the bank which people have deposited on account of SIP. And the number two is the number of accounts which have deposited, that number is 10 crore. And you can see the increasing trend in both amount as well as the number of people who have been depositing that. There can always be somebody switching from one particular fund to another fund, or moving from one fund house to another, and maybe they are like shifting, but structurally, over a period of time, the trend is amount is increasing, and the number of people who are depositing that amount, they are increasing.
So in terms of the money that people are investing, in terms of the investment classes, whether it's the old mix of gold, real estate, deposits, equity, how do you see that changing in the last 2-3 years, and what's your prediction, say, for the next 5 or 6 years?
So people were under allocated in equity, which is what is increasing. Within the equity, I think there's still as many investors who have invested in mutual fund. There would be equal number of investors who have invested in equity market. Either they participated in an NFO, or they are doing an F&O, or they have bought stock. There are like equal number of people. I think for the industry, that's the next target of the investors who already participated in the equity market. But our message is the better way is to invest through SIP in a mutual fund.
So tell me about how does AI fit in the world of asset management from where you sit? How do you guys use AI, and where do you see that going specifically for your fund?
AI, you're talking about artificial intelligence or aspirational Indian? For me, AI is also aspirational Indian. AI is transformational. I write an annual letter. This was my person of the year in 2022, 4 years back. This is one of the most transformation force that humanity has seen. This is as big as agriculture revolution, industrial revolution, information revolution. This is intelligence revolution. I mean, machines thinking on their own. This is something really a paradigm shift, and we really don't know where it ends, because human brain thinks in a linear fashion, and this is the progress here is non-linear. So for us, it's very difficult to to even fathom or visualize what it will do over the next couple of years. So structurally, there are a lot of opportunities for our industry, whether in terms of concession, whether looking at large set of data and doing the summarization, whether there is synthesis of a large amount of data and making sense of it, in terms of content generation and making it easier for us to educate large number of investors in multiple languages. India is a country of multiple languages. We are doing a lot of things on that. On the client engagement, I think you can do personalization at scale, which would not have been possible without AI. And last but not the least is like, you can do coding in an accelerated manner, that instead of a linear, a lot of process engineering, a lot of innovation can be done in an accelerated manner. But of course, one needs to ensure that the security aspect of it and the data localization, etc., we need to pay attention to that. And how do we ensure that there is a lot of Indian innovation there rather than just using some of these models. Yeah.
So one of the reasons why people say that FII has moved out of the Indian market is because the lack of AI stocks, right? And there's also the big debate about the AI bubble, if there is one. Where do you sit on this debate?
Nalin, you are a global thought leader. So if you think about, if it is about AI, then other than United States, which is at a cutting edge. So India is not there in the energy layer, infrastructure, chips layer, infrastructure, models, I think LLM, we are not there. But on the application side, we'll be the use case capital of the world. But other than United States, who's been at the cutting edge of AI? Which country? I'm asking you.
Well, I'd say China.
It's China.
Absolutely.
Look at MSCI China versus MSCI India in last 1 year. China has underperformed India. Look at YTD this year. Despite all the AI talk, if AI was the reason, look at some of the Chinese stocks which are at the cutting edge of AI. What has happened to them relative to India? I don't think it's about the AI alone.
But do you think that we are
If I
heading to
remember
the AI
correctly,
bubble?
Anuj would have those numbers more handy, but I think MSCI China is 10% behind MSCI India YTD.
So one last question. How, in terms of cyber threats and ransomware threats, which have become much more acute in this in the age of AI, how acute is this now from where you sit and the kind of measures that you're taking to guard against that?
No, I think even finance minister, when she was here for the SEBI Foundation Day and a couple of other events, have mentioned about the risk from some of these models. And I'm sure government, policymakers, civil society, everybody and organizations, everybody is working together to ensure that increased risk from whether it's a cyber security, whether the ransomware, etc., how as a nation, as a society, we counter that. Yeah.
So please, one last question. You manage a lot of people's money on a normal scale. What is your personal guiding philosophy on fund management, and how has that changed from earlier in your career, if it has changed?
I'm a hardcore Gandhian, so I mean, he says the future depends on what you do today. And you talked about like all India by 2035 or India 47. I think it all depends on like what we do today. And at SDFC AMC, we get driven by one mission, which is wealth creator for every Indian, to be the wealth creator for every Indian. We manage money. It's a deep, with a lot of humility, and it's a deep pride that we manage money for 17 million people. I mean, it's such a blessing, such a great responsibility and honor to do that, a privilege to do that, but we want to take this number to a greater level. So how do we make more money for the 17 million investors, and how do we get the next 170 million investors and make this nation where it deserves to be?
Thank you very much, ladies and gentlemen. A big hand for Navneet Manot.
All right. Yeah. Okay, thank you, Navneet and Naran sir, for those insightful context to this particular session. But yes, let's move on to the next conversation where we talk about how wealth creation is not just about identifying opportunities today, but also about understanding the trends, businesses, and the ideas that can shape the future. We have seen that the markets have evolved and new growth opportunities have emerged. And that's why the investors are constantly looking for the right balance between conviction, insight, and a long-term perspective. So in this session, we will be exploring the theme, which is Think Wealth Creation, Navigating the Future of Growth Investing, a conversation around identifying emerging opportunities and understanding the market cycles and building strategies for a sustainable wealth creation. So to take this discussion forward, I would like to invite Zoya Springwala from Moneycontrol, and joining her is Akhil Chaturvedi, Chief Business Officer, Motilal Oswal Asset Management.
Thank you so much. Thank you so much for that, Lavisha. So, Akhil, let's just get right into it. Everybody talks about growth investing, but what does it actually mean to you?
So, according to us, we are growth practitioners at Motilal Oswal Asset Management, and according to us, growth investing is all about investing in businesses where the earnings growth or the growth in profitability of businesses is substantially higher, right? So, so we believe that in the long term, growth is equal to return. So, for example, if a company is growing its profits at, let's say, 15% compounded for next 5 years, and let's say 100 rupee profit today, growing at 15% for 5 years will be 200 rupees, eventually will result, into the growth of market capitalization also. So that's the underlying belief, and therefore, we put a lot of focus and emphasis and research to try and look at the trends into the future, some of the top-down themes, sectors, and within those themes and sectors, which are those businesses where we can get higher growth. And as long as the longevity of growth is long enough, you just need to, sit tight on it.
But then in that case, how do you differentiate from a company that is demonstrating great growth versus a company that's just growing quickly?
A company which is growing?
Quickly.
Yeah, so you need to be, obviously you need to think about so the longevity aspect is very, very important.
Right.
As growth investors, we are interested in companies where growth could be stable and secular for a reasonable period of time, rather than buying into growth which is probably into momentum for a short period of time. Generally happens in cyclical sectors. We have seen that last year in metals where, growth was tailwinded for a particular sector, but it's cyclical. So, so if you're in momentum, you can participate into it, but if you want to draw a 2-year chart, earnings chart, so it then becomes slightly difficult, right? So, so yes, different people will think about it differently. If you want to play tactical, you will look at momentum, you will look at these businesses. But I would say that large part of the portfolios should be built for longevity growth than tactical growth.
Okay. So we've gone from a market where, everything was going up. Everybody said you throw a dart at a stock and it's likely to rise. But today we're seeing the market turn very selective. In this market, do you think the definition of growth investing has changed, or does it remain the same for you?
No, the definition of growth remains same. You are absolutely right. Between 2021 and 2024, anything you touch was turning into gold, right? So whether you buy value, you buy growth, you buy quality, you buy whatever you want to buy, it was all making a lot of money. But over these 3 or 4 year period, obviously markets did very well, businesses, stocks did very well.
That's right.
Valuations became very, very rich and very, very premium, and that's what we are seeing over the last 18 months, where the valuations have been correcting. So incrementally, given current valuations, one has to look at that, those opportunities where the growth can actually hedge the valuation, right, or protect or justify those valuations. So in a market where your large cap index is trading at 20 times PE multiple for a 4-5% growth, Your mid-cap index in the last 3 months, again, seen a reasonably good rally, and we are at 30 times. Small cap is at 37 times. So these valuations are very, very expensive, right? So now, within these baskets, you need to be very selective, picky, and choosy, and focus on growth and valuation, right? And therefore, the markets, we feel that for the next couple of quarters, will be very stock-specific, very, very selective, right? So broadly, the indices look expensive, but you need to search for the gems and the jewels within the larger basket.
Right. So at Motilal Oswal, you have interacted with investors across every single market cycle. But in this one, are you seeing that retail investors have wisened up a little bit, or they're thinking about long-term wealth creation, or do you think that they're still looking to make the next quick buck?
So you have a mix of investors, but the broader theme, see, I've been in the industry for 26 years. Clearly, in the last 4 or 5 years, the maturity level of the investors have certainly gone up. I think Indian retail investors are thinking long-term, are thinking of creating wealth over long-term. They are understanding the do's and don'ts in investing in equity. So therefore, very recently in the month of March 2026, when the war happened between US, Israel, Iran, we saw a 12% correction on the market, and that month we saw one of the highest flows, I think upwards of 90,000 crores of gross flows. And then subsequently in the month of April, when the markets actually went up, the flows came down. So that trend also shows that if there are deep corrections, then the participation will go up. One needs to buy on the dips, be careful on the tops or valuations. Yes, there would be some investors definitely who probably are not mature enough and probably would be timing the market. A lot of investors, what I've seen, with data is that those who came in 2024 and they've not made any money now, till 2026. As the markets are going up, we are seeing a lot of investors like, principal वापस आ गया अभी भागो यहाँ से types,
Yeah.
So that kind of a trend we are seeing selectively. That's how we have seen the SIPs have slowed down and the stoppage ratio have gone up and absolute numbers have come down by 1,000 crores. But larger number of investors, certainly I think very, very different from what we have seen until maybe, what we have seen in 2000 to 2010 or 2010 to even 2020.
Right, okay. So going back to growth investing, a very pertinent question that I have is on valuations, because sometimes these companies can command premium valuations. So when is it that you decide that you are paying way too much for future growth?
Yeah, so you're right. Growth stocks generally are not cheap. You will never find growth stocks which will be 10p, 12p, 15p. When you're buying companies which are growing at 20, 25%, 30%, these companies would be trading at 40, 50, 60 times P multiple. So it comes at a price, right? How we look at from valuation perspective is we rather than looking at PE multiple in isolation, because in isolation, when you look at a certain company trading at 50 times PE multiple, and when the index is at 20 times, it may look very, very expensive.
Yeah.
So we pair it with growth. So price earning to growth is a valuation matrix which we use more frequently. So now you imagine that if you buy a 15% growth company at a 25 PE multiple, you're buying it for 1.1, 1.2 peg. Looks a lot more comfortable. So we look at future growth, we look at current PE multiple, we divide it and come at the PEG formula. Our internal frameworks are more, when portfolios are going above 2 price earning to growth and higher than that is the time where we need to do some rebalancing within the portfolio and try to keep the PEGs as closer to 1 as possible.
Okay.
Right.
Okay.
So I think any mutual fund distributor, investor out here looking at growth kind of a portfolio, don't get swayed away negatively by looking at PE multiples. Look at PEGs, and that will give you a better idea.
Okay. So apart from valuations, what are some of the other factors that could make you exit one of these growth investments? What do you consider?
There are many factors. I think, clearly, so we have these frameworks, we call them as QGLP frameworks, quality, growth, longevity, price. If the quality of the business goes down, we exit it out. If the growth comes down, we exit it out. If we cannot visualize growth for next 2 years, we exit out. And if the price looks expensive, we exit out. Or sometimes, the narrative around businesses go bad. Sometimes they are not market favored stocks because you have to perform on a consistent basis. So we have to be mindful as to which kind of businesses are actually outperforming, which are not outperforming for a sustainable period of time, despite everything being right. Q, G, LP, everything is right, but still the businesses are not outperforming, then we need to either cut position or actually move out of the portfolio. So there are many ways we look at, but largely if growth is topped out, if valuations are topped out, or if a certain business is underperforming for a reasonably long period of time.
Right. So we've mostly spoken about stocks so far, but for a retail investor, how can mutual funds help them participate in long-term growth stories for like all of these companies?
In general about mutual funds?
Yes.
So I think, Navneet of course spoke about, I think we have over 40 mutual funds and the number is growing. I think we'll have 100 mutual funds in the next 10 years. I think each mutual fund house is bringing a unique proposition, unique style, unique philosophy, unique portfolio, and investors have a lot of choice now to, we are talking about growth style of investing. We are one of the allocation one can make in a certain style,
right.
But you have fund houses who practice core value investing. Some fund houses would be practicing quality. Someone would practice a blend of all of these. So today choices are available, and my suggestion to our mutual fund distributors, investors is always that rather than buying funds basis on an ad hoc basis, purely basis returns momentum over 1 year and 3 year. For long-term wealth creation, I think style diversification is more important than simply buying, funds with returns. And therefore, have some amount of your money into value style, some into growth, some into GAP, some into quality. Different years, different styles do well, markets rotate, cycles rotate, and you will get consistent performance, consistency in your portfolio, volatility will come down, stable journey, and therefore it will help you to become a long-term investor creating wealth. So diversify across styles within the equity allocation. That will eventually help you becoming a long-term investor.
Okay. And so if we look for the next 5 to 10 years, according to you, what sectors have the longest runway for growth in the next decade?
5-10 years, honestly 5 years still you can visualize. 10 years visualizing is very different.
Okay,
so
in
what
the
we
next
used to
half a
think 10
decade
years
then.
back, nothing is. But yes, 2 years, 3 years, in some cases maybe 5 years also. But 2 or 3 years visibility is a good visibility. I can talk about our fund house, some of the spaces where we have over allocated or we have allocated nicely. Basically are these 7 top-down themes. One is of course the manufacturing theme, which is a core allocation across our portfolios. 30 to 50% of the portfolio will be around manufacturing, which is largely playing on Make in India and China Plus One story. So sub-themes, renewable power is a big theme we are playing out. Defense selectively, cables, wires, pipes. So these are the business infrastructure, capex-related businesses. So this is a very core component of our portfolios. On the financial side, we are overweight on NBFCs and capital market businesses. On the healthcare side, we are overweight on hospitals and diagnostic businesses. Consumer, we are playing more on the consumer discretionary than
right.
consumer staples.
Okay.
And tech has been more, it's not been a great buzzword now, but tech has been more around mid-cap IT
Okay.
or digital businesses. And therefore, you also see that in our flexi-cap portfolios or multi-cap portfolios, larger allocation is more towards mid-caps and small caps because there are the real growth opportunities which are available.
Okay, so if someone sitting in our audience is starting their long-term wealth creation journey, and I hope you guys have already started, what are some principles of growth investing that you think they should never compromise on?
I think entry points are very, very important for long-term journey. Usually, what we see is that you buy growth stocks or growth portfolios at the top of the cycle. I mean, if you just see the recent history, 2024 proved to be the top of the growth cycle, and 2025 we saw growth got corrected. While growth per se was not getting corrected, so those companies were still delivering meaningful growth, but the valuations were pretty stretched, and it corrected by almost 30-40%.
Right.
And therefore, we saw that volatility in our own portfolios, and those who would have bought those tops would have gone through this intermittent underperformance or a volatile period in 2025, right? Equally, 2025, as these businesses were getting corrected and growth was intact, the valuations suddenly started to look very good. So in fact, that 2025 became a good allocation year, while 2024 was a year to be cautious and sit back and watch out. So timing of entry, if one can do adequate research, deep dive, and look at the entry points, then at least your initial journey can be healthy. And if the initial journey is healthy, then you become long-term.
Okay.
But if you buy the tops and then your next 1 year goes bad or next 2 years goes bad, then that journey of long-term becomes actually nothing. People
Fair
just
enough.
walk out.
Okay, so apart from timing, this is my last question for you. What are some misconceptions around growth investing that you would like to clarify right now for everybody?
Yeah, I think misconceptions which I face
Yes.
on a daily basis is that these are expensive portfolios. These are very expensive stocks.
Yes,
So,
even
like
I
I
asked you
said,
that
if
question.
you look at standalone PE multiples, you'll find valuations expensive. Because valuations are expensive, people find that these will be very volatile kind of stocks, or it may end up correcting too deeply or sharply. So I think the fear is all about looking at PE multiples and then trying to form a perception that this means that this is expensive, means that it could correct, means it could be volatile, and therefore, beware.
Right.
But that's not how the way it works, because like I said, that you need to pair growth with PE multiple, then you'll get a fair idea. Otherwise, you will miss the journey because of the misconception around how to value growth stocks.
Okay. Thank you so much for taking out the time.
Thank you so much.
Okay, thank you, Zoya, and thank you, Akhil, for that interesting conversation about how growth investing needs to take shape from here on. Just when we have been, the markets have been scrambling for opportunities, which is revolving around growth. But yes, let's keep the momentum going. And before we move on to the next session for the evening, we at Moneycontrol are super excited to share about the upcoming Financial Distributor Expo. Yes, that's right. Moneycontrol's Financial Distributor Expo, which is your FIDEX, is coming back to the financial city with its second edition. The first edition was quite the success. So for anyone in this ecosystem, it's a space to step back from the routine and look at what's coming next, where the opportunities are forming, what challenges are emerging, and how the distribution landscape is evolving in real time. So let's take a quick look at the FIDEX 2026 promo. Right, that was the FedEx promo, and hopefully the second edition will also receive the warmth that the first did. But yes, sir, let's move on to the next set of conversation. We've seen that India has over 2,500 mutual fund schemes across 44 AMCs. The industry is large, but the gap between the products we build and the outcomes investors actually experience remains real. This panel brings together three leaders at the center of that question on fund categories, risk profiling, investor messaging, and what it actually means to bridge product and outcome. So to take this conversation ahead, I request Anuj Singhal, Managing Editor, CNBC Awaz, to join us on the stage. And, joining him is, I request Navneet Munot, who's the MD and CEO of HDFC AMC, to join us back for this session. Along with him, Sudeep Sikka, who is the MD and CEO Nippon Life India Asset Management, and Sid Swaminathan, MD and CEO of Geo BlackRock Mutual Fund. Please welcome them with a huge round of applause.
Thank you, Lavisha. Well, so good evening, everyone. Okay. Good evening, everyone. Some more energy, yeah. So just some ground rules. I actually have only one, as all of you who have been to some of my events know. No phones, please, because if any phone rings, we'll auction it to the lowest bidder. So, all of you must be carrying very expensive iPhones. We don't want to see that going to, someone next door. So let's start this conversation. We have, of course, a marquee panel. I don't want to waste time introducing all of them again. Let me straight away get down to the business. Gentlemen, thanks a lot for joining us. Now, this topic is actually quite loaded, from product innovations to real outcomes. Sandeep, are we saying that mutual funds are focusing more on how to get more schemes rather than focusing on the best possible outcome for the investors? And going forward, if that's a perception that is there about the mutual funds, what should the mutual fund industry do to change it?
Well, first, thanks a lot for having us today. And I don't think so. I think mutual fund is trying to work too much on the schemes. Mutual fund industry is trying to work, is working to get more and more investors into the industry. And I think one needs to give credit to the fact that I think in the last 10 years, I think where we have reached, especially I think by keeping things simple, by launching products like SIPs, I think what the industry has done is basically has created so much wealth for investors. And schemes are a part of that journey, but schemes are not the focus.
Okay.
So let me, again, I think while we can talk a lot about the success of the mutual fund industry, but one of the biggest things that I think we need to compliment the industry is by keeping things very simple. I mean, you do not have a scenario, where you have millions of investors coming from small cities and towns. I mean, when they are investing in capital markets through mutual fund schemes, I think what the industry has done is has tried to say that I think here's a scheme which is transparent. You know what you're investing in, you know what you're getting into, and has kept it very, very simple. Rather, I would go a step, ahead, when you say this, industry has also done a very phenomenal thing by not try to complicate, by launching very complicated products. Has kept it very simple, and the SEBI categorization has made it even more easier, whether the large cap, the small cap, the mid cap. And SEBI has also ensured more complicated products, which is like SIPs, SIFs and others, are in a different category. So I would not agree with this that the industry has been launching and working a lot on the schemes. Industry is trying to keep it simple and trying to get more and more investors.
Oh, absolutely. There's no doubt that mutual funds have delivered a lot of returns. But Navneet, coming to you, there are hundreds of schemes now, right, in the mutual fund industry. So are we genuinely innovating or just slicing the same cake differently?
I think one of the biggest innovation is the way we have simplified the way of investing through the SIP, that just by remaining disciplined, putting money every month after month, and not trying to time the market can result in that. In terms of the number of products, over the years, the way products have got launched is to meet certain need of a set of investors or a set of advisors and distributors. But the way the industry has compounded money in very simple products, what Sandeep talked about, I'll just echo that. In our industry, investor testimonials are not allowed. So we cannot publish the money that an individual investor or a distributor, what they have made by investing on a certain date, because we have a certain format of performance disclosure. But I can say with deep pride and sense of satisfaction that while walking in, one of the distributors who's sitting here gave me a statement of his investments made in the year 2000 in some of our funds and the way money has multiplied. Now, these are like simple products. What has led to this multiplication of money or the compounding of the money is just remaining disciplined and remaining invested. Now, more number of products, I just think like you go to a restaurant, I mean, different restaurants will have like maybe a pizza with maybe onion, without onion, because there are certain people who don't have that, or maybe a pizza with a thin crunch, or maybe without that, or maybe with more cheese, less cheese. That doesn't mean that every pizza has to be exactly the same, but credit to SEBI, and this has only happened, and SEBI has worked outside India can add more. Only country where the amount of standardization, the uniformity and the comparability that SEBI has worked on, that every AMC can only have one large cap fund, one mid cap fund. What large cap is? The top 100 stocks in terms of market cap. Then you need to have a unified benchmark. The entire industry use benchmarks which are like very comparable. The way we disclose our performance. In US, you can have somebody who's investing only in Max 7 or investing in income securities or investing in dividend yielding stock or global value stocks, and everybody can have an S&P 500 as a benchmark. In India, it is not allowed. So I think there is a lot of standardization, there is a lot of work on comparability that has been done.
Okay. Of course, we have a lot of mutual funds listed now. Said yours is not yet listed, of course. So let me just ask you one question. Over the last few years, we've heard a lot about, factor investing, smart beta, thematic funds. How much of this is about growing the mutual fund industry versus growing the investor wealth?
Yeah, it's a good question, and I think you need to think about it as a customer segmentation answer, right? So when you think about investors who are very early in their journey or yet to begin their journey, the story is completely different, right? That's why you need to simplify it. You need to, develop good habits, and Navneet is right. Like we have this amazing good habit of like the SIP investing, which does not exist elsewhere in the world, and we need to do more of that. So just getting people into the markets with simple to understand products and getting them into that discipline of investing through SIPs is crucial, right? Now we can help them as well. So to your point on the excessive number of funds, now for some of them that could be daunting and confusing. So simplification through education or through how do we simplify asset allocation, whether it's through model portfolios or advisory or whatever that is one piece that we need to work on. To your question on like the more nuanced exposure, so whether it's factor investing, thematic investing, we've talked about SIFs as well. There is still a space for that for the more advanced investor. And remember, we have all of that in India, right? We have had this tremendous growth over the last 5, 6, 7 years where more and more people have come to the markets, they've been invested primarily in equities, developed their wealth, and then are now looking for differentiated strategies to diversify their portfolios. And once you get into that thinking, that's when these kind of peripheral strategies come into play. It's not for everyone, I agree, but there is a growing segment of the population, and I think they will continue to grow, that will want these specific exposures because it's a complement to their existing holdings.
Oh, absolutely. Now, Sandeep, I'll come to you as well, but Navneet, just a word on thematic funds, because, that's been the buzzword for quite some time now. But data shows that thematic funds actually come at the fag end of some kind of a rally, right? I mean, we saw with the defense fund, we saw with the EMS fund. So what's your take on that? Are you in favor of thematic funds or no?
So it's a journey, as Sid rightly mentioned, that as the investor starts a journey, they need to start with maybe a simple diversified equity fund, maybe a large cap fund or a flexi cap fund. As you evolve, as you become, get more sophisticated, understand the risk, want to take certain exposure, you have a core portfolio and then want to have a certain satellite of, let's say, taking exposure to certain themes, certain sectors, you can do that. There again, SEBI has done a lot of work in terms of ensuring that there is no too much of overlap between two sector and thematic fund within the same fund house. You cannot have 3 consumer funds by different names. The portfolios have to be very distinct. The theme has to be very distinct, and then only you can launch another fund. And the way the risk get highlighted to the end investor. But also it requires a lot of discipline on the distributor and on the part of the asset managers. You talked about the defense specifically. We were the first one in SDFC to launch our defense fund. We closed the NFO 2 days before the actual date of the closure because we thought that, I mean, the way money was coming in the first 3 or 4 days, we thought that expectations are not getting set rightly. It seems people are allocating more thinking that this fund will substantially outperform. It substantially outperformed, but still it's a thematic fund, and on the risk return spectrum, it's slightly higher. Immediately after the NFO, we closed it for lump sum subscription, and we said we'll only take the SIPs. And there was a period, I think probably one of the only open-ended fund, where for a period where we were not taking incremental SIPs also. Fund was doing well. The fund managers were positive on the structural long-term theme. But our fear was that the expectations are getting set based on the past returns, that in 1 year or so, if money is doubled, people thought that the fund would continue to deliver this kind of return. So I think every fund house and the distributors need to ensure that expectations get set rightly, and we don't encourage the recency bias where people look at a sector or theme based on the last 6 months and 1 year return.
Well, actually, that brings me to the next question, and Sandeep, I want you to answer that. We saw over the last 2 years many mutual funds stopping the small cap inflows or reducing or the lump sum inflows. Of course, we saw a resumption of that in the small cap space. Should mutual funds do that, or should mutual funds actually tell their fund managers, look, I mean, at the end of the day, people are investing. They want small cap investing, let them invest. As fund manager, you have to weigh your risk, you have to manage your risk, and you have to make sure that you still generate decent alpha.
I'll club you this question with the earlier question, also mathematics, because ultimately the theme for both the questions is the same.
Yeah.
It actually depends on what type of investors are you catering to. So let me give you our example. We have very retail investors, in small cities and towns, are almost 28 million investors. We have taken a little different view. I think we don't launch thematic funds. We have not launched NFOs. We believe, I think it is because investors many times get carried away with the fact that what is the flavor of the season, and they may not be so matured and too smart to understand this. The best is not to do it. I mean, we'll do that in our AIF, we'll do that in our PMS, but we will not do in the mutual fund scheme. And also, let me give you data which will help you to understand this. If you were to look at globally, Indian markets are still maturing. When we look at, especially, and this is even more true for the passive, which is simple, and you talked earlier about the factor and various things. Globally, if you were to see all global markets where you have passive, the mainline indices, which are the top 3 or 4 indices, they are 80 to 90% of the AUM. And that's also true in India. So effectively, whether you see Nifty, Sensex, BankX, gold. So investors typically make more wealth, investing in simple products. And when you talked about the innovation in the industry, the biggest innovation of the industry is that industry has kept it very simple. To your question on small cap, I think it is prudent. I think many times investors do get carried away by seeing what has happened in the past. And it is prudent, and I think you should appreciate, you earlier talked about some of the AMCs are listed. I think you should give credit to the industry, how industry is maturing in spite of putting their own interest behind. I think they've stopped the flows. The small cap funds, when the flows were stopped, so in our case, we had the largest small cap fund, which was about 60-70,000 crores, doing well, and saying that we're not going to taking money tells you how responsible the asset management companies in India are. They are no more into the asset gathering mode. They are being showing more responsibility towards the investors.
Oh, absolutely. And Sandeep, if you've seen me on CNBC Awaaz, even though it's a money control event, let me just plug my channel as well. I have given mutual fund industry a lot of credit, but here I'm just trying to play devil's advocate. So, Sid, you want to weigh in on this? You have a bit of an easy task right now because you have only one scheme right now, right, Rishi? I think I keep talking to Rishi, but right now you have only one scheme, right? But you want to weigh in on this topic of thematic funds and small cap and the topics that we discussed?
Yeah, look, I agree with both Navneet and Sandeep, right? I think, firstly, it has to be positioned correctly. So people have to be educated around what role it's going to be playing in their portfolios. And then, yes, if there are genuine concerns around kind of the overall sector in terms of kind of the euphoria that's built around, and you need to like temper that, I think the industry is making those right kind of calls. Now, we have to be careful we're not making it for the wrong reasons. Like it's not something as a function of there's illiquidity in the fund and that's why we're doing it. That's not what's happening here. It's much more at an industry level, not at a specific fund level, because that's the big kind of delta here. So 100% agree that when the time is right, these kind of checks and balances, just to kind of take a little bit of the pressure off the system, and then when the times are right, you kind of open that back up again. I think that's a very prudent measure to be taking.
Okay, let's move to a topic which is very close to my heart, and either of you can take this question, or maybe all of you. Why is our industry still talking about returns instead of goals? Won't a better way be to say that, okay, this fund, your fund, well advertised, it's generated so much returns, but how much should you have invested, say, particular years ago, to reach a particular goal? Because if you had invested, if you had done an SIP of 10,000 at 15% returns versus say 15,000 SIP at even 12% returns, the result would have been different. So should we move from talking about just returns to goal-based investing? Navneet, maybe you want to take it first?
No, I think the whole SIP book, the journey from 3,000 to 30,000 crores has happened because industry is talking beyond returns. And if you look at the most powerful campaign, the mutual fund Sahi Hai, the entire campaign is about power of compounding, not getting swayed by the volatility, ensuring that you invest in a disciplined manner. That's been the campaign, that don't get swayed. I mean, look at your goals for which you are investing, then remain on this journey, remain disciplined. Don't get influenced by the greed when the markets are very bullish. Don't get fearful when everything looks very pessimistic. And that has been the larger message of the industry as a whole. And there is no other place in the world, Anuj, where the entire industry, which competes with each other during the day, but collaborate and in a highly cohesive manner and present the case to the investor that this is the reason for which mutual fund exists. This is how you need to, identify your right goals, do the asset allocation, select the right fund, and then stay the course. This is something very, very unique that as an industry we take a lot of pride in.
So you're itching to pitch in on this one.
No, I think I cannot agree more with you. I think it has to move towards a goal-based, and it is moving. The fact that as an industry we cannot talk directly about returns. We cannot say that I think 1 lakh has become 4 crore rupees over 30 years period. We are not allowed to say that. I think it's clearly the growth of the industry. The backdrop of this is basically silently, it's all goal-based investing. The new life cycle funds, which has also been launched by SEBI, is a step towards that. I think the way I see every asset management industry across the globe, you go geography by geography, it matures. Initially, the first step is to get people into the asset management industry. These were the people who were investing in banks or gold in India, they came to mutual fund industry. You have to educate them what is mutual fund. I think the next step was basically to give them the confidence that you can create long-term wealth. And I think now, in the earlier session, Navneet talked about, how generation after generation things are changing. I think we see the new generation, I think the day they start their job, the first thing they do, they start SIPs. And the only difference is, whether we call it goal-based planning or not, they think very differently. The Gen Z, they think about, I'm going to be saving so that I can go for a holiday to this place, or, I can go to, a Taylor Swift contest and a concert kind of a thing. Their thinking is different. But indirectly, goal-based has already started, and it's getting better day by day.
Yeah. And if you ask my daughter...
There is a category solution-oriented funds where you have children fund, where you invest for children's education, and there are retirement funds where you invest money for retirement. I think industry can do a lot in growing those categories because there you are not choosing funds based on market capitalization or sector or themes or what you talked about, but looking at the goal and then investing, because what it brings in is the discipline that this money is for a certain goal and I will remain invested and I won't get swayed by intermittent volatility.
The SIPs did not stop in India because a lot of these were for goal-based. I think had this been a scenario, if people were not investing for a goal, the kind of turbulence we have seen for 2-3 years have been almost, I think investors have not made money, but the fact that people are sticking on to the SIPs, that tells you that I think investors are looking at, they have a goal in mind, they're sticking to it, and they are not getting swayed by the market turbulence.
Oh, yeah, I mean, I asked this question because, my daughter, she's 10, she asked me, Papa, have you saved enough money so that if I have to go for Taylor Swift concert worldwide tour, you'll be able to sponsor it? So that, got me thinking whether I've done enough or not.
The reason I give this example, this is the problem with daughters, they all want to go to Taylor Swift.
I said, of course, you have worked, outside India. What's the difference that you've seen outside versus here in terms of goal-based investing? Do you think Indians are getting there in terms of proper goal-based investing, and are mutual funds helping them?
Yes. So the short answer is yes. So we clearly see the path that is being followed here, and it's probably going at a much faster pace here than it has elsewhere in the world, to be honest. But where some of the countries are, and especially if you look at the US, UK, etc., majority of the flows now, in terms of what goes into the funds, is coming through model portfolios. So over 50% of the flows is all through model portfolios. So that is, whether it's through an advisor, whether it's through DIY, that's just how investors think about investing in markets now. It's starting to happen here. So we're still starting to see a lot more of that. I think where we can see more of an evolution is also, yes, goals-based, but then overlaying that with kind of the risk tolerance piece, right? Because that's important. And we do a lot of this risk profiling. Risk profiling isn't just filling out a form, right? It's really, how do you behave? How do you react? How do you feel when the markets drop 10%? And if you feel a certain way that it doesn't give you sleep at night, then don't be 100% in equities. It's that kind of, I think, acknowledgement that investors will need to start developing. And I think as investors mature, they're seeing more of these market cycles here, and that's starting to come into play more and more. So I think we're definitely on that journey, and we're moving faster than most countries have moved, but there's still a long way to go.
Okay, now, we have about 4 or 5 minutes. Let me just go through some rapid fire questions with all of you. I've prepared some questions, and really let it be rapid fire. Sandeep, one product category you are most excited about?
Mid-cap.
Mid-cap. Navneet, active or passive?
Both.
Okay. Sid, India small cap or US equity?
Sorry, was it
India small cap or US equity? If you were to choose, which one would you choose?
I will go for US equity right now.
Yeah.
Controversial.
Navneet, would you agree?
India small cap.
Sandeep, what about you?
India all the way.
India all the way. Small cap versus mid cap versus large cap, Navneet. Which will generate more returns?
I mean, on a relative valuation, of course, large caps have underperformed, and I think foreign portfolio investors selling has also played some bit of role there. That looks attractive, but structurally, if you are investing money for the long term, I think India is a stock picker's paradise, and there are opportunities in the mid and small caps also.
Sandeep, one investment mistake that most Indians make even now. Don't say watching business channels, huh?
No. I think they start investing very late. I think this is a trend that what we have seen is, that people start investing very late. You need a nudge. It does not come naturally to people. But that's changing with time, and I think the new generation is much better off compared to when we started investing.
Said one financial habit every 25-year-old should adopt.
Financial habit?
Yes.
SIPs, 100%, no doubt about it at all.
Starting early, SIPs.
Yes.
Okay, now, of course, Mr. Kumar is not here, but one regulation, Navneet, that you would change tomorrow?
One regulation?
That you would like to change tomorrow?
That you would like to change. So currently, Indian mutual funds can invest up to 10% of the capital of a company. I think over a period of time, we need to liberalize that more and allow the domestic funds to buy more. If you are a private equity, if you are an individual, if you are a corporate entity, if you are a global investor, institution, I mean, there are like Japanese banks who have taken a much higher stake in a bank. We manage money on behalf of millions of investors. So domestic investors getting a higher exposure to Indian corporates should be looked at.
Okay, now I have one question. I have written the first line. I want all three of you to write the second line. Okay, so the mutual fund industry right now, we are at about 80 lakh crores, right? Very hopefully we'll be at 100 lakh crore AUM soon. Now the question is, the 5 years from today or 10 years from today, Sandeep, let me start with you. The real success of mutual fund industry will not be crossing 200 lakh crore AUM. It will be your answer.
Every Indian household is a mutual fund investor.
Superb answer. Please, a round of applause for that answer. Navneet, your answer?
Yes, similar. How do we ensure that there is a greater participation in India's growth?
Greater participation in India's growth. Okay. Sid, what about you?
I'm running out of options, isn't it? Majority of the new flows are coming from beyond the top 30 cities.
Superb. Okay, one last question perhaps. In the world of AI, do you see that as a risk or as an opportunity? Navneet, because, I can go to a laptop, ask ChatGPT, give me the portfolio of Navneet Munot, and quickly tell my broker to invest in those stocks. So do you see AI as threat or opportunity?
So Navneet Munot using AI will be better than Navneet Munot without usage of AI. But whether AI can replace, I'm no longer a fund manager, but whether AI can replace an advisor or a fund manager, my answer is a clear no.
Oh, absolutely. Sandeep?
So I think AI is here to help us, but not replace us.
Not to replace us. AI will complement and not replace, right? Sid, would you agree with that?
Exactly right, yeah.
Okay, thank you, gentlemen. It's been a privilege having this conversation with you. And I hope you enjoyed this conversation. Please, once again, a big round of applause to all our panelists here. Thank you so much.
All right, thank you to our speakers, and thank you, Anuj, for taking through this conversation. Hopefully, everybody enjoyed this conversation. But yes, let's move on to the next set. Let's talk about how global markets are getting repriced. AI, geopolitics, trade tariffs, persistently higher rates in the West. The investment landscape looks very different from what it did just 3 years ago. Now, the question now here is that where does the capital go from here on? From AI to infrastructure, from public markets to private assets, where will the next $1 trillion of capital, global capital flow? And which opportunities are investors still underestimating? I request Rishi Kohli, who is the Chief Investment Officer at Geo BlackRock Mutual Fund, to join me for this discussion. All right, what a time to have this conversation. Because if you take a recap of how markets have been in the last 18 months, then we will see that, there has been a completely two different narratives. Last year, it was all about tariffs, trade disruptions. This year, it has been about geopolitical narrative and, of course, the risk premium that came with it, energy disruption, crude prices soaring to about about $116. But now we have seen that there is a fair amount of cool-off when it comes to the crude oil prices, 30% down from the recent peaks. Do you think that now markets can look past this geopolitical risk?
Yeah, thanks for that question. So I think, overall markets in the long run do have these cycles, right, where they do well for a few years, get overextended, then, reasons will come and they'll become softer, come down, go sideways. So there are these phases in the markets. And of course, different reasons come by at different points in time. This time, again, going back 18 to 24 months, as you said, if you think about it, we had a stellar run in India for 3-4 years or more, 4-5 years actually. And obviously, valuations had got overextended, a lot of flows coming in at the peak from both valuation as well as price perspective. Things were overstretched. And then earnings growth started disappointing. Till that time, for a few years, earnings growth was also strong. And obviously, in the long run, markets, do track the earnings growth kind of thing for returns. So markets had to cool off given all these conditions. I think the reasons that came by were just supporting that decline overall. If those reasons had not come, some other reasons would have come. That's how markets behave typically. Markets do tend to move 3-6 months, ahead. as we've seen a lot of data on that, not only in India, but globally in the long run. But yes, coming to now, fast forward to now, what has happened is last 2 quarters of last calendar year, you saw earnings start ticking up slightly, right, after a long time. And a lot of smaller metrics, like since we are focused on a lot of data-driven analytics at Geo BlackRock, so things like upgrades versus downgrades, how many target price changes have happened, up versus down in terms of analyst sentiment, all of that, when you look at it very, very quantitatively as well, those things started changing on the margin quite a bit. That plus the earnings growth recovery seemed to make consensus change to March quarter end being very, very bullish. Now then the war happened, that disrupted it a little bit in terms of sentiment and expectations. But finally, when we've seen the March results now, they have come out much better than people were expecting. And therefore, it seems like the blip, that due to the war and crude price movements, etc., that we were expecting. Of course, some of it will still show up in this coming quarter. But overall, I think that impact has been lesser than what we were fearing at the worst. And, even in the 2 years of dull Indian markets, we always said that, India macro was rock solid, very strong, much better than we've seen in 20 years. And that got shaken for those few months. But again, now with oil cooling off, and I'm pretty sure it's still going to be a little volatile. It's not going to remain at the lows or the highs. But even if it settles down, $10, $15 higher from here, and I think it will, I think India's macro again remains solid as ever. So that is a good support. Domestic flows, of course, very talked about. We all know about it. Earlier panel also touched upon it. That continues to be strong, and we are still scratching the surface in terms of the penetration. So obviously, from a 6-7 year perspective, when I look at it, then there's a lot of bullishness that can come from there. Having said that, of course, even currently, earnings as well as valuations, etc., are quite dispersed. In a long time, you're seeing this kind of dispersion. And therefore, I think stock selection, sector selection, all this will remain important. It will not be like a smooth uptrending market, which is secular. So you will get these 3-6 month patches, which will be good for overall markets. And then you will get a lot of sector rotation, stock rotation happening, according to me. And those are the pockets of opportunities that, everyone has to take advantage of. What is interesting is, again, quantitatively, I've been tracking this for my 25 years of career, that when healthy sector rotation is happening, it's a healthy sign of an underlying long-term bull market. And even in the last 2 years, that has been happening very nicely. If you go back to 2000, 2001, 2 period, that had completely stopped. And therefore, you knew that for a few years, you won't go anywhere. But that has been continuing. So there are lots of pockets of opportunities, therefore.
Got it. Rishi, yesterday we saw key data that, India has finally come up back to the 5th in terms of global MCAP rankings. And that's pipped behind Taiwan and even South Korea back into their 6th and 7th position. But the key question here is that we have already seen both of these indices, be it your South Korean markets or even Taiwanese markets, they have rallied quite spectacularly this year. If you look at KOSPI, that's nearly doubled. Taiwan is anywhere 50% up. So the question here is that, do you think, and that's twofold, that do you think that from here on, the AI trade is something that everybody will be watching out for, and are investors really pricing in too much optimism for the AI trade? Because despite the kind of, the spectacular rally that we did see in the past, last week we have seen that there's some bit of a correction. So will the sentiment really derail when it comes to the AI narrative? Or does this narrative still holds key into the future?
Yeah, so I think it'll be mixed. There are lots of AI companies globally where the earnings are still coming through very, very strongly. So again, I think everything has to be looked at from that PEG ratio kind of metric, right? Just P's or just earnings growth doesn't solve the picture. You look at both combined, and that is still attractive for a lot of stocks globally. So I think there is tailwind for them to rally further. But of course, there are pockets which are overextended. So I think it'll be mixed. Again, I think the easy part of that trade is over. Now people will have to start getting very, very selective. The other thing, just from a quantitative data perspective, is that some markets have just blown out completely vertically. And whenever that happens, again, you can never say when they'll slow down or when they'll crash. And usually it's never the first 1 or 2 times of volatility that it crashes, but typically the 3rd or 4th time is when the markets do correct very, very sharply. So I think we're somewhere in the middle of that phase. So it could easily extend by another 1 or 2 years overall. But I think it will start becoming more selective from here on in terms of the earnings growth wherever it's coming through.
Got it, got it. There's an interesting statistic that Alphabet's value currently is at about $4.4 trillion. And that's largely the entire MCAP of our listed space. And even the profit base of it is similar to the entire listed space of us. So what does that tell you about how global wealth is being created?
Obviously, in the US, there are lots of stocks and the market is much, much larger than ours. But that is where the opportunity is, right? When we look at India, and earlier panel was again talking about small caps and other things. So the good thing about India is, and that is actually one of the reasons why BlackRock has come to India now and why, the Geo BlackRock joint venture exists, because of data, right? So we are very data-driven, systematic, etc. And that, if you go back 15 years, you did not have the breadth, the depth, the amount of data that you have now on each of the companies, the kind of disclosures that the regulator has encouraged over the last 15 years, all that has also improved the transparency a lot. So all of these things are what enable, systematic data-driven investing. And all of this has happened over the last 10, 12, 15 years, one by one. And that is why BlackRock has, come to a country like this. And that is where the real opportunity lies, according to me. Because obviously there are lots of small caps, a lot of mid caps. We are talking about sector stock dispersions. And that breadth and depth that I'm talking of, that really, whether you're a fundamental discretionary manager, obviously you have many more stocks and sectors to choose from. For us, from a data-driven perspective, the more the breadth, the more chances of us delivering alpha. So from all perspectives, the opportunities are much larger here. And obviously there's a long way to go to catch up to, some of the stocks like how you mentioned and markets like that, which are much, much larger. But the fact that we have the breadth, depth, the talent obviously means that, next few years can be very good for us from that.
Okay, got it. At present, but it seems like the global investors want to pay more for those companies which own AI or chips. NVIDIA, for instance, one of the most valuable company at the current stage. So does that make you question about how the global capital flows have been flowing in? And of course, what does that tell you going ahead in terms of, where does that leave India in this particular picture, where, the street is much more optimistic on innovation rather than deployment?
Yeah, so I think definitely innovation, R&D, all of this has to happen. A lot of data floating around recently around how for the tech companies, the R&D spend is much, much lower as a percentage, and in many other sectors, biotech and other sectors as well. So obviously that has to go up, but I think at least on the very small companies, the startup side and all, a lot of developments have started happening. Even on the listed space, a lot of small cap stocks where, a lot of the newer manufacturing, defense, semiconductor, a lot of those themes are coming in. So I think that's very healthy. Of course, we've, missed, we are slightly late to it, so it will take some time. But finally, all of that is coming through. So next few years, I would be, quite excited about that development. Okay,
got it. Rishi, rupee has finally fairly stabilized. If you look at today, also it closed at about 94.75, against the US dollar. And we have seen that, RBI, government, they have done a lot of efforts, to stabilize the rupee. But the key question is that when will the foreign money come back to India and when?
Sure. So, see, the FPI flows, one thing we must remember is that, at a larger level, the interest rate differential between, US and India is easier comparison. But overall, we all know carry trade, et cetera, and there are different manifestations of that, right? At some point, the money was flowing from Japan, but overall, you have to look at it in India versus US context, because finally, the largest pool of capital is there, and, indirectly, that has an impact on everything that is happening globally. And when we say the FPI flows, were consistently very strong, that was the time when that differential was huge. Now it is much, much narrower. So obviously it will have an impact, right? So that is something, it is not a direct comparison, but somewhere, that is linked to the FPI flows. So it's not so talked about, so I wanted to highlight it. The second thing is very interesting, again, from a data-driven perspective, that 15 years back, I think the FPI flows mattered more because they sort of led the markets. Their inflow, outflow actually drove the momentum in the markets. What we have seen in the last 7-8 years is that it's the reverse. So if you have a trailing 6 month of strong positive returns in India, you'll see FPI flows coming back. If you see a strong 6-month outflow from India, strong negative return, then it'll go out, right? So they seem to be following momentum rather than the other way around. So I wouldn't worry about it that much. I think it's over-analyzed, over-dissected. Quantitatively, we don't see too much correlation. The correlation is all over the place. So it's like zero in the long run over the last 8 years. And in patches, it will be positive, in patches, negative. So I think we should stop worrying about it. Earnings growth coming through, you'll see markets doing well. That's the only thing I would look at.
Okay, got it. We are running out of time, but just one last question before I let you go, Rishi. I mean, as an AMC, we are seeing a lot of product offerings coming into a market like this. And, every fund manager that I was talking about, instead of sector, they talk about, bottoms-up investing. So in a market like this, how do you think that investors need to reassess in terms of their capital allocation, what their strategy should be going ahead?
So I think it all boils down to asset allocation and diversification to reach the right asset allocation, and that is where even as a house we are trying to do something very different, right? So Jio, BlackRock, both large names globally, but finally they decided that we will do active investing in India, but we will do it very differently from everyone else, where we will take a data-driven, systematic approach. And there, one thing quickly I would highlight to everyone is that we've done a lot of global research, which summarize that there are 3 distinct sources of alpha. One is stock-specific or idiosyncratic, as it's called. Second is sector. And third is factor style. Globally it's called style. Locally we call it factors. And these are 3 distinct sources of alpha. So actually, we talk about diversification between equity, fixed income, commodities, let's say a little bit now. But actually, even within equities, you can diversify between stock, sector, and style. And that is not something which is very commonly discussed or understood by large sections of people here. That education needs to spread, and we want to spread that. So we have something which is focused on stock-specific alpha. We have something which is focused on sector-specific, and we'll come out with other things also going forward. So one is that kind of diversification. Second is, of course, this new development on the SIFs, right? And we recently launched our NFO of the first hybrid SIF yesterday. And I think that's a very interesting introduction by SEBI, and the industry is already lapping it up, and it flows and interest is increasing every day. Because that is largely the missing middle between equity and fixed income, which was not there in India. They can be very different spectrum of risk returns that can be there when you marry a lot of different types of strategies. But given the regulations and product innovation that was there, that was largely missing, which with these SIFs between hybrid, equity, and other categories, it can come in now very beautifully. So early days, obviously, more players will come in. We'll see, some of us will do well, some of us will not. Some strategies will do well, some will not. So it'll be the similar dispersion to other schemes, but finally there'll be some, which will be very interesting. And I think that diversification will also help almost all portfolios, right? So I think those are interesting developments, and those are interesting ways to look at diversification and looking at asset allocation in a portfolio.
Okay, all right. All right, with that, to let you go, Rishi, but thank you so much for this conversation.
Thank you for having me.
All right, that was Rishi for us, and let's move on and delve into the next set of conversation. The gold ETF OM, that's up by about 148% in a year, more than double. So multi-asset allocation funds that have grown by over 50% as well. And SEBI has introduced the SIFs, a new product class for sophisticated investors that allows long-short strategies. GIFT City is opening up access to global allocation like never before, and the portfolio of today is not what it was a decade ago. So what should it look like? Please welcome Anisha Kumar from Moneycontrol to lead this discussion. And now please welcome 3 fund house CEOs who are building that answer. Vishal Kapoor, CEO, Bandhan AMC. Swaroop Mohanty, Vice Chairman and CEO, Mirae Asset Investment Managers India, and Jatinder Pal Singh, CEO, ITI Mutual Fund, and B. Gop Kumar, MD and CEO, Axis Asset Management Company. Please welcome them on the stage with a huge round of applause.
Thank you so much, Lavisha. It was a perfect segue from the last question, where Rishi spoke about SIF. So now the product landscape in India, especially in mutual funds, has changed, if I could say, drastically over the last few years. We've got multi-assets, we've got, FOFs, we have now even the SIF framework that has come in. The regulator also has been very active in trying to, bring in new spaces for, investors, to offer investors the opportunity. And the AMCs have been playing a very important role in, taking it forward. Now, what is really interesting, this is also the time where our investor base has also changed. We have, investors who are now doing a lot of DIY, and they're also asking a lot of why questions. They're not just investing, in the few funds that were available. And today we have a, wonderful panel of, CEOs who are going to talk about, how they are looking at the changing, product space that is there and how it's impacting portfolios. So perhaps maybe we'll start with Gopkumar sir. And if you could perhaps talk about, from where you sit, where have you seen the single biggest shift in how investors are approaching portfolio management right now?
I think over the years, the customers have changed their behavior. I think largely because multiple reasons. One is that, which is the recent one, is that how social media is shaping the people in terms of the behavior.
So if you just make it.
Is it okay now? Yeah, the social media is actually changing quickly the behaviors. Second is also that financial products is also getting into maturity level. So if you look at the most developed country like US, you have so much of options to invest, just not on active funds. We have passives, we have private assets, the multiple opportunity to grow. And you also seen that people who came to investing in this country 25 years back when they started putting money on markets today, they also got matured. And they also have now an opportunity to think about saying that, can I get better products? Can I get a product which matches my risk profile? Can I get a better asset allocation? These are the challenges. The last panel also spoke about number of schemes what an AMC brings in. Yes. One of the reasons which I think about is that it is also derived from the demand coming from the customers. Right. And our job as an asset management company is to produce products, and the distributors like them, they suggest customers based on their asset allocation. Our idea is to develop as much products as possible so that they can advise properly and do a better asset allocation. So there are multiple factors why the behaviors have changed, just not the social media now.
Sure. Vishal, if you'd like to chip in for the same.
Thanks. I hope I'm audible. Okay. So I think the conversation has shifted. And if I trace back clearly the last few years and the volatility in the market over the last 2 years may have been one of the factors that have allowed this shift to be more accelerated in a sense. So from a traditional view of saying India equities, India fixed income, now you've discovered international equities. And the shape of shift, if I were to try and summarize, so from saying which fund, more people are now asking about what's the allocation in the fund. That's the next level of questioning, right? Or rather than just looking at return, what's the risk-adjusted return? So that's the change in vocabulary that we are seeing. Or just looking at, okay, should I add one more fund? People are asking, am I truly diversifying by adding a different source of return? So there is a significant shift. Now, as managers, in one sense, we are just manufacturing to a more diverse toolkit that is available. So I think kudos to the regulator to allow us to do a bit more. Right. Because clearly if the customer need is shifted, given what we've seen in the markets, because of volatility, because of the range of products now available, I think through SIFs, through Gift City, through international investing, etc., and just the plain vanilla multi-asset fund, BAF, etc. There are enough strategies that can be done in traditional funds as well. So let's not keep it outside. I think it's about providing a stronger continuum for investors, which is a great development, I would think.
Sure. Thank you. So Ripsashi, perhaps, obviously the way, portfolios were managed were very different earlier than what they're today. So if you were to, have an ideal portfolio right now, how would you like to start investing? What would be the ideal mutual fund product mix that you think would have been the ideal product mix?
For myself.
For yourself or for, in general, where should people have started? Like we used to do earlier, like a mid cap and a flexi cap, the very core products, but now it's different.
I think what's happened is discussions happen galore, but the focus of an investor remains absolutely intact. The investor, and that is 80% of industry flows, focuses on last 1 year return. Yeah. Discussions can happen. And that's where we are losing the plot. Today, mark my words, if at Mirae Asset we put up 1 year glorious performance, we can ask the sales team to sit at home. And all of you will do the job of getting the money. That is how skewed it has become. And this 1 year focus is the hindrance to portfolio creation, is an incredible hindrance to asset allocation. And that's what is plaguing the industry now. If you're going to go from 4% to 8% penetration, we are the only country in the world which invests in market cap products. Only country. Nobody talks about large cap, mid cap, small cap anywhere. The world is investing in 12 stocks. Korea is investing in 3 stocks. Taiwan is buying 1 stock. That is where investors have gone. Today, if you look at the diversified fund for performing has to necessarily allocate in a small part of the country, part of the market. Whether it's PSU, defense, international, now healthcare, tomorrow IT. The investor will soon know that allocating there will make money, and that is where the cookie will crumble. I hope the cookie crumbles sooner than later, and that is what will expand the market. If I were to build my portfolio today, and which I am building, I don't want to share my portfolio, but my portfolio has had a fair share of a brilliant small cap fund from Bandhan. It has had some good products apart from Mirae. But what really built wealth for me in the last 1-2 years has been my allocation to silver, my allocation to a manufacturing index, my over allocation to healthcare. That's what has given me the alpha. So today, 60-70% of my portfolio will go to thematic investing, and probably 30-40% to a Nifty 500, and no longer in Nifty 50 is the way I look at products. So we are building products, but this focus of 1 year return is really being a big hindrance to the industry.
Sure. Siksa, if you would also kind of chip in on this, how would you be building your portfolio?
Just to tell you background that I am like a 95% equity investor for multiple years. So go back like from the time Swaroop and myself, and I just talking to Vishal, we are from the same place, eastern part of India, we are from Calcutta. Swaroop and myself worked in the same industry, same place for about now 28 years, right? So same kind of traits we have. Let me tell you, the problem is this, we understand risk. And if I am telling you I'm 95% equity, it basically means even if market is 50% down, and this happened in 2008, I bought a house when I came to Mumbai, I bought a house in Mumbai. So market is down 45% or so. So I take equity as a current account if required. That if it's down 45%, if I need money, I'll take it. If it's up 100%, if I need money, I'll take it. The problem was that I also have an MFD advisor, and the problem is that if you use the word advisor, it is taken negatively. But I also have an advisor who made sure that my allocation comes down. But call it luck, call it vision. I think last 7-8 years has been very kind to us because I've been about 60% mid-cap. It is only last 2 years that I started increasing my allocation to small cap. I was 0 small cap. But my call was very simply, liquidity is not there, and mid-cap is like small cap. So he talked about silver. So I'm a gold investor, and when I talk about gold, I'm talking about when gold was 30,000 rupees and so on. And my call was, shouldn't be talking about this, but call was, it'll go multiple times up. So the thing is, if you are investing before time, you may need to have patience. There's a frustration premium which will get paid up later. So today, mid-cap allocations all remain, but incrementally it's towards small cap. So I'm just keeping it simple, and some bits of it also going to some thematic, as he's talked about. But my vision is about next 5-7 years, because last 2 years, if we have not made or made little money, then we are going into a zone where we will make the alpha for the sacrifices that we have done. In the same conversation, I tell my if I'm talking to some advisor, I'm talking to MFD, that what you have sacrificed last 2-3 years, we will be paid up in the coming time. Naturally, you know, I'm backing it with growth. I'm backing it with some other economic angles. So equity and bits or pieces, I think it's more to do with small cap and mid cap and thematics.
Sure, sir. So one particular product that has really picked up, I think, over the last year or so has been a lot of these passive funds. So we've seen ETF and index become, a core part of, investors' portfolios, and even fund houses have, seen a lot of, launches coming in. Now there's this constant, debate that goes on saying that are there too many passive products? How are you approaching passive products right now? Because that's one area where there's a lot of opportunity to add more for investors from the, the conventional ones.
I think my view is passive versus active. I think there's a debate. Usually we have it every time. I think my usual one-liner is that if the customer is looking for a cost-effective solution for him, I think the passive is one way to look at it. I'm not saying that he has to do passive as well as active. My view is that passives have very important part of your asset allocation. Having said this, there are a number of products available now in passives. I think one is style-based, index-based. Some are very, very complicated. I think my view is always that as long as the product is simple, understand. A simple product means if a distributor understands and able to communicate to customers very easily, I think that's a product you need to buy from a passive side. Otherwise, passives sometimes may get much more complicated because in my view, India is in a very, very nascent stage in passives. The number of passive products available globally is too large. In my view, and what data says is that passives are larger than the active funds globally. That means people have started getting passives. I think more and more the way I think about it, I think even our regulator today spoke about active funds. If you don't beat benchmark, whatever he spoke about. My view is simple, is that as long as in India we're able to beat benchmarks, I think active plays a critical role in your portfolio. It's okay to pay some fees, but you're able to get that alpha there. Right. To answer your, summarize my conversation with you is that it's a part of our portfolio. Make sure that you understand the product well. And sometimes it may get complicated. Right. And we also sometimes do some complicated products. There are products which we would have done only for a large private bank, not for retail, but generally sometimes it flies from your counter. So that's what happens. So my view is that passives is a fairly good allocation for your portfolio.
True. So I want you also to kind of weigh in on this, on regard to passives. I mean, when is too much, or is there more that, the mutual fund industry can offer to investors in the passive space? How are you looking at it?
No, but why is it that in every aspect of life, an average Indian asks or dikhao, but when it comes to investing, people don't want variety? See, by the end of this year, 60% of incremental folios will be for age under 30. That investor is a Bitcoin investing investor with absolutely no problems with taking losses. This is moving from risk-averse investors to not risk-seeking but risk-owning investors. So our job is to provide products across the risk spectrum. But this obsession with our generation of market cap is stopping people from going to some incredible ideation that's happening on the passive side. I'll give a small example. One product which I have, one product which I don't have, and one product which will come to fore after today's EV sort of thing. The manufacturing index has beaten every fund in this industry by a wide margin with a volatility lesser than everybody. Now that that is there, people will start buying it after everything has happened. The capital market index of India, which I don't have, is probably the most diversified capital market index globally. And some of those companies are getting warmed up. But we'll feel, arey, wo capital market thematic hai, return aayega, sab aayenge. Suddenly, global investing has come to the fore after seeing US returns. Fund houses has been talking about global investing since inception. Kab se bol rahe hain, dollar spending hai, to dollar asset banao. But abhi sabko global chahiye. Right? Now when today the country has woken up to EV and some things have been decided on EV, a product called EV which has not performed, which looks incredible for the next 20 years, will not find buyers till it does not perform. Uske baad kharid ke kya fayda? So the beauty of passives is that wherever there is an investable universe, we can create an index. And through factors, we can give multiples of that index as suitable products for every investor, which due to categorization of active funds, there is a limitation. So while there is a limitation of actives on number of products or ideation, that is unlimited on passive. So the ideation that can happen there is phenomenal. And trust me, the 30-year-old guy does not look for a 30 stock product. He or she is looking for a bhadakta huwa 10 stock product, which passives will give. If we don't give, they will buy Bitcoin. We will lose. That's the truth.
So, Vishal, you were just talking about, why should we ignore, things like, BAF and MAF. So, your dynamic asset, your balanced advantage. So, these are not necessarily newer products, but they're products that haven't picked up as much. We do see inflows, but they haven't picked up as much. Though in this kind of market that we're seeing, they would have been the ideal products to actually be investing in. So what is the reason you think that hasn't really happened, that, the aha moment hasn't really happened for things like, BAF, MAF right now?
I wouldn't say that it's not happened. I think, just echoing some of the points Swaroop made, see, it's a function of, firstly, let's understand that there is no one investor. There's a very wide range of investors. And as manufacturers, we are not generating returns. We are just offering products which can behave in a certain way, right? Now, the investor can either try and mix and match and generate their own return, which is where in some pockets we see behavior which is additive, or it can be negative as well. Right? So it depends on how you're using the tools that we are offering. But often a large part of this risk-return trade-off or the portfolio creation is actually done by the advisor. So it really, I think, boils down to who are you working with, and I think, like every study will tell you, that the fund manager's return is not the portfolio's or the individual's return, because a lot of leakage happens because of behavior. And that behavior management often becomes the most important variable to control. So I don't think it is as much about, we just heard that if you just bought a large fund, let's say a flexi cap or a large cap over 20, 25 years, the compounding in India is stupendous. But how many of us made those type of returns on our overall portfolio? So I think behavior is often not talked about as much. And to my mind, a BAF, MAF, and potentially an SIF, the asset allocation type products actually do a phenomenal job, potentially, of attacking that behavior management. Because when you come to, let's say, a multi-asset fund, the FOMO feeling that we often have about, did I have this, did I have that? Oh, the gold is rallying. Do I have gold? We'll say, yes, actually in your MAF you have gold. Silver is rallying. Do I have silver? Yes, I have this. Okay, international is rallying. Do I have this? Yes, you have some bit of this. So it's actually a great tool for managing behavior, because of which investors end up holding it for a much longer period of time, and therefore potential of return becomes far better. So I think these products, while they're still called traditional products, are incredibly powerful. But end of the day, as a manufacturer, like I think the point was made, we have a full range of products across the risk spectrum that we will manage. If we can find a good source of additional value that a manufacturer can provide, because of either an investment thesis or an index availability, because we can manufacture it, we have the skills to be able to do it, we'll offer it. But I think the magic is really how you mix it.
One word that has been coming up, regularly has been SIF. I think there's a lot of, conversation that's happening about this within the market. And I would love to get, everybody's opinion on this. Maybe we'll start with Singh. So how are you looking at the SIF opportunity right now from an AMC perspective and from an industry perspective? And where do you see this kind of going?
Sure, I think it's thanks to SEBI, this stand was taken about a little bit more than 1 year, and the product started coming 7-8 months back. So what they did is they brought in the long, and let's say the unhedged portion which we can use, and we can be hedged 100%. So the flexibility of management of a product has gone up. So you can, according to valuations and other calls of the market, tactical or strategic, you can manage the product. So this gives lots of flexibility in the portfolios of investors. The only thing to remember is what I have understood in a little bit is in the last 6-8 months is no SI, while we have 7 categories and most of the products have been launched in 4 categories out of that, I think 3 are still to be launched. Debt has not been launched, and I think maybe 1 or 2 has been launched in active allocator. But even if multiple fund houses have launched schemes in the same category, what I'm understanding, the way of management is very different within that. So to the advisors, you need to, not only understand the macro of the scheme positioning. Sorry, you don't have to only understand what SEBI has said, how the scheme is to be constructed. You have to also understand how they are going to manage and what outcome will be. For example, within the hybrid, we have directional products. We have products, within the hybrids which will move within the medium and higher level of risk, and then we have arbitrage plus products. So, and each product can be placed differently in the portfolio of the investors, from almost very low risk to say, to maybe, since we can't leverage, I won't say more than 100%, but a risk like a long open products, like because we can have 80-100% open positions also. So innovative, flexible, and I think it gives a chance to the distributors to have a new conversation with investors, which can be for acquisition, because arbitrage products can be utilized for fixed income and fixed deposits to move here over a period of time, and the risk management which we can try and do can take care of markets in certain conditions. The only thing is the long short products were meant from risk adjusted angles. Just because daily NAVs are coming, fund managers are not gods who will know that 3 p.m. they have to be short and next day at 9:30 they need to be long. So they are also going to take a medium to long term view, but maybe more agile than the long. And so daily movements, monthly movements sometimes can be in favor or against, and that is what everybody needs to be aware about.
Sure.
Yeah, I think it's an incredible time to be an asset manager because the investor is changing and we are changing in our behavior. I think let's face it, and I think when you look at the whole, the regulator actually choosing our platform to launch this speaks of itself. More important from that investor perspective, he or she gets a more transparent, easier product to deal with and more tax efficient. I think what people need to know that in the absence of categorization of funds, each fund house and each fund manager can now express his or her portfolio in the form of SIFs. So like, the big point that no two SIFs within the same category will be the same is something which people should look out. I'm personally really kicked about the debt SIF. We've just filed one. And then see, for some reason, the industry has become very defensive on the debt side, on portfolio construction for whatever reasons, on taking credits. It allows us to take credits. And if over a period of time we can consistently put 1.5–2% above FDs in this country, a lot can happen for the mutual fund industry in getting a 10 lakh check from, and 10 lakh is not a big check today in India. And I see great upside from us as asset managers to add great value to the debt side of this market, which for some reason we've forgotten as an industry. So the equity side is always talked about, but for me, I think the clinching factor will be our ability to deliver a consistent debt SIF return to the investor, and there we can add a lot of upside or value to investors and can create a new path for ourselves.
Vishal, obviously I would like to your view on SIF also, but keeping mind time also. We can't end a conversation about products without talking about two things, gold and global. Now with Gift City, again, there's a lot of conversation that is happening with regards to, global investing. So I want to understand, how are you looking from an AMC perspective? How are you looking at the space? How are you looking at products within this space? Gold, Gift City, and SF. So you could kind of give.
Yeah, so I think both are additional asset classes which has got probably rediscovered in the last couple of years, just given the returns. So as asset managers, I think we have many options in the way one can access it, whether it is ETF or outbound funds, etc., etc. But I do want to share one caveat in all of this, right? To the point that we made earlier, I think something Swaroop also mentioned earlier. See, we will provide products. But often what you don't, as an investor, this FOMO or this thing about trending products is where we see an issue, which is that, everyone seems to be buying it and let's buy it, and this recency bias where, because it is done well, I will keep buying it and the momentum builds up, etc. I think that is what we have to be a bit wary of. So is international investing a good idea? As an industry, we've been trying to promote it for more than 20 years, right? But if suddenly you're buying it because you are now enamored by 50-60% returns that some market has delivered, I would say be very cautious. Because, so why exactly are you going into these products is, I think, a more important question than the availability of the product. So just because it is there or someone is offering it because there's a new vehicle available, that shouldn't be the reason to buy it. But as manufacturers, if there's an availability for us to be able to offer it efficiently, we'll definitely try and do it.
Kumar sir, you have the final word.
Yeah. The last one is better. Quick one on the SIF side is that I think it will challenge existing products, especially on a BAF and arbitrage fund. My view is that it will change because if it's able to give the similar risk return better than returns of the existing products, I think these products are going to be challenged. My view is that the large segment like arbitrage fund is a 2,50,000 crore category. I think that will get completely challenged. We are not yet launched. We are on the way to launch, so we've done a lot of work around it. Another point which I'm saying is that these products were not available for retail investors. Today, access to these products are very important. What regulators bought it, and these are great products. This was only one of the alternate platforms. Only large HNIs used to participate there. My view is that SIF as a product will change the way advisors will advise to the investors now. And more important is that they also bought it's a certification compulsory. I think this is a tough exam. I think if they're able to pass, I think there's enough education is done forcefully. It also led to ensure that, let me tell you that I was a distributor like you 3 years back. I have seen other side. I still say that most of the AMCs, even today, don't understand derivatives because we are largely long gone. We are largely long gone. Let's accept it. I find difficult in my own organization to create that ability because number of derivative products we use to hedge our portfolio is very, very limited. If you look at a fact sheet, you can see that. But for us, it's a large learning because you have to ensure that even your back office as well as your custodians has to learn to settle the trades. So these are challenges. So that's on the Gift City. Suddenly the FOMO has come in. I think that's what Vishal spoke about it, right? We also ran a China fund. One fine day had to shut because there's huge amount of social media pressure on us and the limits were got over overnight. It's a 24 hours, we just got out. My view is that if the international allocation or the commodity allocation is very minimal to your portfolio, I think there's no meaning to invest in international equities or commodities. That's my view. There are challenges in Gift City. I think me and Vishal was part of that IFCA conference. I think one of the reasons I say is that the paperwork is so too much that it becomes at least 20 days to onboard a customer. And especially when you do a retail, it's impossible to do it. I think there are a couple of challenges. I think we've been working on it. I think most of the AMCs like us will do a digital journey. I think that will help you to onboard a customer. But we still have a challenge because, for example, if I have to get a $100 SIP, I can't do SIP because banks don't accept the mandate. So there are a couple of challenges, but I think some point of time from here, I think Gift City will become much more retail. That will happen. I think we'll see a couple of more retail products will get launched. And that will be a meaningful allocation to the investors. Today, when I look at portfolios, they're not meaningful. For example, we also run a large and mid, which we have an exposure 8-9% to international equities. We run that from ages. And interesting, 2 years back when I saw our international funds, it was hardly nothing. It was some 800 crores. I used to call it an Anath fund because nobody used to speak about it. In 3 months' time, it is around 7,000 crore fund. Just FOMO. And when I shut it, I think I had a biggest social media fight on me. I think you also know you was tagged. Everybody was tagged. And they wrote so much bad about me. We just invested because we had to take a call because most of the money was lying in the FOF layer. And the existing investors were making losses because I didn't have a limit. And I can't cross 5% more cash. So I'm just giving an example of how FOMOs work in this organization, in this market. So I think you will see the large change. The GIFT City will get retailized and get a digital journey on.
Sure. But Gop, Vishal talked about behavior. Let me give you a very interesting behavior. In ELSS, most of the money comes in the last week of March, retail side of the business. In GIFT City outbound, on March last 2 days, because last 2 days of LSR, we got 497 checks of 1.5 crores each on the last 2 days. So whether it's an HNI or it's a retail, behavior does not change much, is my conclusion.
You lose the limit of LRS.
Sure. So thank you so much. Obviously, there's lots to discuss. We're extremely, we have our wonderful last panel also waiting for us. But thank you so much, everybody. Really appreciate your time and inputs. Thank you so much.
All right, thank you, gentlemen, for that lovely conversation. And of course, thank you, Anisha, for steering that conversation as well. Let's move on to the next set of conversation where we talk about how India's equity markets have been in a period of consolidation. We have already seen a heavy selling by the FIIs this year. Earnings growth in FY26 came in at about 6 to 10%, which was way below the historical averages. Even the small cap index, that has corrected by over 25% from its peak. But yet, domestic flows, that has quite held the fort, and DIIs have been consistent buyers in a market like this. SIP inflows have just recorded their 53rd consecutive month of positive equity inflows, and the fundamentals are quite intact. So the question is where the alpha is hiding. So to moderate this session, please welcome once again Anuj Singhal back on the stage. And now please give a huge round of applause to 3 of the sharpest equity minds in the country who will take that on. Rahul Singh, CIO, Equities Tata Mutual Fund; Ramesh Mantri, CIO, White Oak Capital Mutual Fund; Trideep Bhattacharya, President and CIO, Equities, Edelweiss Mutual Fund; and Sridatta Bandwalder, CIO, Equities, Canara Robeco Mutual Fund. Thank you to our speakers, and of course, welcome them.
Well, the topic is markets in consolidation mode, where to find alpha. Of course, one alpha you can find on Friday, the Alia Bhatt movie releasing, but we are not talking about that. We are talking about the real alpha that all of you have mastered in generating. Now, let me go through an opening line which I want all of you to remember, because towards the end, I'm going to ask you a question which is related to that. So the opening line that I've written is that now for 4 the dips have become deeper and deeper, right? And what has happened is that the market feels very different, right? Index returns have been quite abysmal, and valuations are still elevated despite all the underperformance, and stock price picking is back. So has investing become harder, or is this finally the market which the active fund managers like all of you have been waiting for? So just remember this, and I'll have a question towards the end. So Rahul, let me start with you. Where will alpha come from in this market?
So alpha, actually, our view is alpha always comes from growth. Now, today the growth is in power, bits of healthcare, and that's where the alpha is coming from. And definitely not in IT. It's not growth is not in IT. Banks, I think growth is coming back. With some triggers in place, I think growth will come back. So I think you have to, and some pockets of consumer will always have alpha. You know, there will always be some pocket, some sub-segment of consumer which you can use to generate alpha, and that's the beauty of consumer sector. But barring that, you know, alpha will always come from growth. India is a growth market. We can try playing value. You know, there will be some pockets of value you can keep in your portfolio. But if you're lucky, you will generate alpha once in 2-3 years from value. But on a sustainable basis, it always comes from growth. And you have to, you know, keep your eyes on which sector, which companies within the sectors or companies outside or independent of the sectors are driving growth, which are beating not just GDP growth rate, but your peers' growth rate. And that is where we have seen sustainably valuation getting re-rated, maybe getting excessive at some point of time, and you have to be, you know, you have to be smart enough to realize when that happens. It's not easy, and, you know, we always forget when to sell some of those names, but that's where I think I firmly believe alpha is going to come from.
Okay. Ramesh, what kind of market do you prefer? There was a market in 2021-22 where perhaps your stock picking ability could be worse than your peer and you would make more returns, versus the market right now where the index is not generating anything, but beneath that, if you have picked right stocks, I mean, some of the returns that we have generated in stock-specific moves in India are at par with some of the big markets that we've seen, whether it's Korea or US. Your thoughts?
No, as an active manager, you know, strong trending one-way markets where everything goes up is actually difficult for us, because in fact we like to balance risk and reward, and that's a phase of the market where only risk gets rewarded. You know, the sweet spot for us is these kind of markets, whereas an active manager, you know, the right balance of risk and reward matters. And so actually I absolutely love this kind of market.
Okay, and do you think in this kind of market you will be able to generate, say, 15% returns? And by the way, by 15% I mean per year, yeah? Because in 2021, investor expectation had gone up to 15% per month. We have left those markets way behind. So now, will you be able to generate those kind of returns?
See, I think over time, longer term markets tend to deliver nominal GDP growth, you know, which historically in India has been about 11, 12, right, long term. I think if you add a few percentage points of alpha and active manager, you can end up with 15. But that's also effort. I don't think we have any birthright to get 15% per annum. But markets cannot at aggregate deliver 15. Markets over longer term will only deliver, let's say, 11, 12%.
Actually, that is my question. You know, Trideep, if let's assume we get 12% earnings growth, in that case, can you still deliver 15% CAGR? Because that's what, you know, I'm paying you my money for, right?
Indeed. I think earnings growth is one. Picking the stock at the right valuations is the second. I mean, for instance, India has always been a stock pickers market. Even in a sector like IT, which has gone down significantly, I can name 2 stocks which are up about more than 30%.
Yeah.
So, you know, and it will continue to remain so. So what we need to find is the pockets of those growth. So one, for example, at a very broad level, if I may say so, India seems to be changing the pivot from services-led growth to a bit more towards manufacturing. Now, in this transition, there are many pockets which are currently there, many pockets which are developing, and many that are about to come, which will present, in my opinion, strong alpha opportunity for investors going forward, far in excess of the number that you sort of, you know, talked about. So I would say that, you know, the alpha opportunities are, you know, plenty even in the current so-called, as you call it, flattish market. But even in CY25, which you call as tough market for India, broader markets gave you 10% return, which is not a bad number to start with.
No, absolutely not. It's just that the expectations got elevated post-COVID, and that's where, Shridhar, you know, a lot of new investors came in, they saw the markets, and they thought markets only go one way, which is up. But things have changed. Have investors' expectations come down? And what's your sense? What kind of returns can one expect, say, with a reasonable 4 or 5 year time horizon?
I think, first of all, earnings come in cycles and the returns come in cycles. I think most of the time, and this doesn't This is not true about only equities. This is true about actually all asset classes, just like what you saw in gold, you saw in small caps. I mean, in every asset class, there's a cycle where either the underlying cash flows come and you get the returns. If you actually step back and start thinking about what happened in 24, everybody thought that while our long-term earnings potential is 11-12% at aggregate level, like what Ramesh said, but everybody was assuming that the 18% CAGR between 20 to 24 is our birthright. I don't think that is going to get repeated. But at the same time, I would be far more relatively constructive today because we have had tapering down of expectation of earnings. I'm not so much worried about valuation. As long as earnings actually recover, I think we'll go towards that number that you are speaking about at portfolio level again, not necessarily at market level. And I see there's a good chance of that happening because the earnings estimates across the board have been tapered far more today, except mid-caps probably as asset class, as compared to where it was, say, a year back or 2 years back. So that's how actually we are looking at it.
Okay, how many of you here have seen their portfolios go up by 20% in last 1 year? Be honest. Not a single one. And how many of you have seen a degrowth in your portfolio value in last 1 year? There are only 5 honest people in this room. Okay, I'm sure a lot of you would have lost, but maybe don't want to accept it. Okay, now, the next part of question, I'm going to divide it in 2 parts. First is where you are worried about the consensus, and second is where you think everyone is ignoring a particular space. Ramesh, let me start with you. Which is one consensus which worries you? Biggest consensus trade that worries you right now?
So I think there's a lot of interest in this AI-driven investments in India, whether it's industrials, whether it's power and all, right? You're trying to catch an AI story in India. Reclassify every potential company as an AI company.
Yeah.
So that is, and that's a global risk actually, what is happening to the whole AI complex. If that changes, that's probably the biggest risk to a part of the market. I think the part of the market that will surprise in India, I believe is a potential, is consumer. It's been out of favor for quite some time. We had income tax cuts last year. We had GST cuts. That, in fact, the March quarter was actually the best quarter for consumer companies in a long time. But of course, again, it got saddled, the Iran conflict.
Because of war, yeah.
But I think consumer stocks have corrected.
Because of the GST cut, the impact of the GST cut?
No, it's actually a lot of recovery, even in sectors which are not benefiting from, because see, income tax cut came in, that also came, that has nothing to do with GST at the start. I think initially we did not see the benefit because the money till January went into gold and silver. Everybody put their money into gold and silver. The love for gold and silver got over in January. And then I think the money started now flowing to consumer.
Absolutely. A lot of us have actually forgotten that there was a income tax cut in budget. So much has happened in last 12 months. Shridhar, same question to you. One consensus trade that worries you and one opportunity that you think the market's overlooking.
I think clearly industrials, which is quasi-AI trade. While I agree with Trideb that generally movement from services to manufacturing is playing out, but in this particular space, 3 years back, people are not willing to believe that companies can make 10% margin. Today at 25% margin, people are willing to believe that this is going to sustain. So I think we're completely on the other side in terms of valuation, the earnings estimates, the margins where the companies are sitting, and on top of that, the ownership. Because even the FIIs have actually in India, if you look at the data, net sold the sectors which are out of favor, and they have actually bought industrials over the last 3 months. And I think that's one sector which clearly worries me. While we like it fundamentally from a long-term perspective, but near-term clearly there are going to be significant disappointments in my view. So that's on the risk side. I think opportunities. Clearly, 2 spaces. Financials, I think people are still underestimating that the credit growth is running at 15% for several months now. So at least for few of the financials, particularly the private banks, as well as large diversified NBFCs, is clearly going to reflect in terms of growth surprises. That's how at least we are looking at it. That's one space. Second space, like what Ramesh said clearly, every single time there has been tax cuts or basically consumption spent by government, state governments plus central government. If you go back 20 years, every time the first sector always has been beneficiary, has been part of consumption, which is auto, and then it has percolated into the other sectors. While it has started percolating, the numbers have started actually improving at the margin. But because people are completely enamored by the other side today, I think a lot of people are kind of completely ignoring the part of consumption.
Okay.
Part of it is tactical, probably FMCG, but consumer discretionary, I think, as a space is something which is more structurally now.
Okay, so the gentleman on the left basically agree on both the points. Rahul, what about you? What's one consensus trade that worries you, and what's one hated space that you would like to get into right now?
The hated space I would like to get into is insurance, because I think there's just too much of negativity around what kind of regulations will come, what it will do to growth, what it will do to profitability. But if you look at insurance companies, I think they are on the right side of whatever regulations will come. As manufacturers, I think their profitability and growth might actually get a lift up. So that's clearly one sector. And it's also like banking, it's also at the bottom end, I mean, at the 2 standard deviation below the mean kind of valuation range. And in terms of what consensus trade worries me, although I like the sector and I mentioned that that is where growth seems to be coming back, it's still a big consensus and big holding for all of us is banking, because it worries me because it is so consensus now, and it is an over-owned sector. So my worry is more from a technical point of view, not from a fundamental point of view.
Okay, but if banks don't move up, the markets won't move up. So
exactly, but you have to worry about it.
Okay.
As a portfolio manager, if you don't worry about it enough, you'll not be able to manage it well enough, I guess.
Oh, absolutely.
And I think that is why you have to worry, even though I am optimistic. So you have to manage both sides of your brain to be able to manage, because that's the kind of market we are in.
No, absolutely. And I think it's quite brave of you to say that about the biggest sector. Tridip, what about you? Same question.
So I would say, within financial services, wealth management and asset management in terms of overall future opportunities for investments is something that I see as undervalued versus what the potential is over the next 5 to 10 years. And I would also put in that the same bucket, export-oriented manufacturing, which has got completely smacked on the back of this trade deal or lack of it, are the 2 areas that I do see value coming in with versus where we are. Where I see risk is basically the new age consumption, where, I think people are betting too much on growth versus the lack of focus on profitability. And, every day somebody announces some sort of policy, and on the back of that, some of these consumption stories go up as though there is no gravity. So those would be 2 bottom-up specific, India-specific areas.
That's a lot of meat that all of you have given me. Now, let me ask one question to you, Tridip, and let me start this round with you. When you're buying stocks, are you buying narratives or are you buying numbers? Are you buying narrative or are you buying numbers? I mean, do you buy a great promise, or do you wait for the company to deliver the numbers first before buying? Because we are talking about generating alpha.
Yeah. So I buy my ability to understand the earnings power of the company's 3 to 5 years hence. And at the moment, I buy into the disappointment that they have probably not delivered in the near term. So it's basically a time arbitrage which I'm looking to play, which is the current disappointment to future delivery of number at some point, which will come on some or the other. A different framework probably, but related to what you just asked.
Absolutely. Rahul, I was reading a quote today, and it struck me. So let me ask you, do you buy a great company at a fair price or a fair company at a great price?
No, the first one. Great company at a fair price. Okay. I think the second category used to be a very potent source of wealth creation during Ben Graham days, where there was enough, little or less probably, markets were less, efficient, and you could find those valuation anomalies. These days, you have to understand the earnings driver going forward for you to find value in it, which is why a great company at a fair price.
Sure. Rahul, you want to answer that as well?
Yeah, I mean, obviously great company at fair price, if you can find one, in India especially, very difficult. But you get dislocations in the market, and you have to take advantage of that. But I will connect it to your previous question also, whether you buy narrative or bottom up, because that's a very important question. And it's like the Hindi movies में बोलते हैं ना, कहानी की मांग. So कहानी की मांग, if I'm running a business cycle fund, I will give more credit to narratives.
Okay.
Right? If I'm running a business cycle fund, and I can even buy a basket of, say, power companies.
Okay. If I'm running a small cap fund or a bottom-up, any other bottom-up fund, the narrative becomes relatively less important. The bottom-up becomes more important.
When you're buying narrative, for how long do you wait for the numbers to come up, or do you give them a fairly large rope?
In narrative companies, what happens is that the valuations move up before the numbers move up. So most often than not, if you've got the narrative right, then you will end up selling, or you'll end up at least booking profits before the numbers actually come. If you get it super right, I mean, if you get it really hit the ball out of the park. But if you are wrong, then you have to realize fast enough, which is where the bulk of the struggle is, to realize when you are wrong and how long do you wait. And I think it is true for stocks also, not just narratives.
Okay. Ramesh, now interesting question that I want to ask you. In this kind of market, do you go for a concentrated portfolio or do you go for a diversified portfolio?
See, okay, I'm very clear, India provides large investable opportunities and the market opportunity is growing. Every IPO in India creates a new small cap. Even if a large cap IPO happens, it creates a new small cap. So I think the universe is growing. The variety of investment opportunities that exist in India are growing. 7 years ago, there was not a single AMC or a wealth management firm listed in India. 8-9 years ago, there was not a single insurance company listed in India. There's so many sectors yet to go public in India or going public in India. So the universe is expanding. Some of these companies, when they start, they have to start small because nobody rarely starts big. So, and many of these opportunities, you cannot deploy a lot of capital even if you want to, because as of now, the opportunities are small. But I would still love to invest in those opportunities because when they become successful, they'll become bigger companies. So the right answer is clearly it's a bottom-up investor. I would love to have more concentrated portfolios, but there's so much opportunities that we end up with a diversified portfolio.
Okay, that's a good one. Shridhar, if someone is starting investment journey now and has horizon of 5 years, right now, what is more important to you, valuation discipline or earnings growth? I mean, would you pay more valuation for companies which are growing at a much rapid pace, or would you rather stick to valuation comfort in this market?
No, I think it's never black and white. It is a combination of both these things. So I'll give you an example of both the things. If the opportunity pie is very large in a particular segment and it is expanding, of course you have to upfront pay a little higher. Okay, and there are businesses which are traditionally well understood, mature businesses, where of course you have to always go for valuation comfort. So that's a combination that you have to work with. From investors' perspective, I think he shouldn't get into this. He should just focus on, like previous panel was saying, that somebody who has been more disciplined in his asset allocation in any part of the market, he has made enough money if he has been disciplined in his behavior rather than what fund managers are doing. So I think that's the way to look at this.
Rahul, India is one of the few markets where actively managed funds have beaten passive funds, some of them by a good margin. Do you see that continuing?
It is not easy. It's not easy because the market breadth has increased. So Nifty 500 becomes extremely difficult benchmark to beat. But I think as the dust settles down and as the valuation frenzy kind of goes up and down, settles down, over a 3-year period, it's much easier than over a 1-year period, is how I will put it. And even large cap category, I was looking at performance, including ours. We've been able to beat even in large cap. So this whole debate about that you can only beat it in small and mid and all that is, I think, a little bit of overdone logic. I think large caps also managed with little bit of a good mix of contra and compounding kind of companies mix. I have seen a lot of portfolios able to beat benchmark in the large cap segment also, which traditionally belief is that you can't beat large cap. Nifty is the best. Nifty index le lo, and I think that does not work.
Okay,
not always.
Okay, Siddip, a tricky question. These days we have 25-year-old kids using cloud and chat GPT, uploading the PPTs of companies, the audio presentations, YouTube interviews, and generating handsome returns because the AI is giving them information that earlier perhaps was only with fund managers. Do you see that as a bit of a competition?
No, actually. I think what's happening is, earlier, as I said, investing is all about having an arbitrage. So earlier there was information arbitrage, which is what AI is actually cutting down to practically nil. But at the same time, there is something called an insight arbitrage, which comes from basic understanding or fundamental understanding of the sector or the earnings power of companies. And that comes after years and years of research. And I think true alpha, which is sustainable over a period of time, can only be generated if you have an insight arbitrage over majority of the players in the market. Not insider information, but insights coming from industry trends or company-specific trends. So I think that bit, AI for sure, is something that won't be able to take it away. I'm fairly confident over a period of time. The other part, which AI might not be able to take away, is the greed and the fear. And I'm yet to see an accurate model of greed and fear developed by any sort of, howsoever bright the kid he is and whichever school he went to. Till that time is there, I think as portfolio managers, we still have our jobs.
Oh, absolutely, and I hope we too as well. Okay, now, Ramesh, is this finally a market where valuations or rather fundamentals matter? Because we had gone through a period where it was all about liquidity.
No, I think the liquidity dynamic anyway has changed, right? With FI selling, it's more now local money that's sustaining the market. And we had this post-COVID a strong euphoria in markets and all, but now we are more focused on fundamentals. See, there was a period I've seen for a few years in India after COVID. So companies would report bad results for sustained time and the stock wouldn't correct. Now it's actually changed. Now markets are actually responding to earnings and fundamentals. So I think that way it's a far better market now where you will get rewarded and punished both depending on the fundamentals. So that way we are in a more sustainable market.
Okay. Sridhar, what's to your mind, the biggest risk right now for investors? Is it local or global? The market has gone through a lot and it's still not corrected. I mean, it's seen a time correction, but still not seen price correction.
Well, market has not, see, risks are always both, global as well as local. But risk has always been around. It's not as if the risks has not been there. And the biggest risk, I don't see macro or micro, or global or local as a risk. I see a lot of investor behavior as a bigger risk than actually the global or local risk, because a lot of people over last 3-4 years have gotten into this feeling that if you come to equities, it means you are guaranteed a 15% return or 20% return. And I think that is misplaced because ultimately earnings have to play out. Thankfully, this year I'm seeing lesser risk than last 2 years because one, the valuation exuberance is far kind of moderated. Second, the supply is keeping the market in check. Third, clearly while market is ignoring today for last 2 quarters through tariff related stuff as well as war related stuff, we are clearly seeing more number of companies beating the earnings estimates. Earnings have already for even Nifty 500 already moved to 12%, 13% last quarter, which is a very, very healthy sign. So I'm seeing more opportunities today as compared to last 2 years than actually a threat or a risk. Risk is clearly, in terms of how investors have behaved for some time. But this is true about, it's always true. Like even in gold, people did the same thing.
Okay, one word answer. I have a sentence, there's a fill in the blank and you have to fill the blank. Ramesh, let me start with you. The next multi-bagger will most likely come from?
Consumer.
Sridhar, same question.
I think consumer.
Consumer.
Healthcare.
Healthcare.
Healthcare as in not pharma, but healthcare.
Not pharma, exopharma, yeah. Diagnostic hospitals, all these chains.
Export manufacturers.
Export manufacturers. Care to be a bit more specific?
Indifferent. It could be in, it could be
textile?
Textiles or auto ancillaries or whosoever, maybe, industrial manufacturers, multiple of them.
Okay, so as I said, when I started the show, I'll go back to my opening line. And if we meet 5 years from here and we are doing the 10th Moneycontrol Mutual Fund Summit,
My opening line were that for nearly 4 years, investors have bought the dip and they have not been rewarded. What would most likely be my line 5 years from here? Rahul?
5 years from now, I think the line would be that if you the investors, I think, kept on. I think investors stopped at the wrong time adding, and that is when the market, started moving up.
Okay.
That would be my line.
Siddhi, what would be your line?
Earnings are non-linear. I'm glad I bought the dips because it caught up in the immediate last 5 years.
I'm glad that I didn't exit the market, right? That could be one as well. Ramesh, what do you think?
Equity is the best asset class in India.
Equity is the best asset class in India. Sridhar?
I think I agree with Pradeep that basically earnings have been sidelined for the last 2 years. So I wish I had bought at that point in time rather than worrying now. The worrying was last 2 years, yeah.
How many of you believe that even after the last 1 or 2 years, equity is the best asset class in India? Okay. So looks like the bottom of the market might still not be done. If we go purely anti-consensus, right? But anyway, gentlemen, thanks a lot for your time today. It was a wonderful conversation. I hope you liked it. And please, once again, a round of applause. Thank you so much. And you've been a great audience. Thank you to you as well.
All right, thank you, gentlemen, and of course to Anuj for steering that conversation. And of course, that was the final conversation of this evening. And that brings us to the end of this HDFC Mutual Fund Presents Moneycontrol Mutual Fund Summit 2026, which was co-presented by Geo BlackRock. A big thank you to all our speakers, distinguished guests, and our lovely audience for being part of the conversations, which has shaped the future of how India's mutual fund industry has been. And a huge round of applause for our partners, presenting partner HDFC Mutual Fund, co-presenting partner Geo BlackRock, powered by partner Axis Mutual Fund, event partners Tata Mutual Fund, Motilal Oswal, ITI Mutual Fund, Trust Mutual Fund, Edelweiss Mutual Fund, and associate partner Reliance Industries. If there is one thing tonight has shown, it is this, that the industry is evolving fast, but the conversations are only just getting started. So yes, let's carry them forward, and please proceed towards dinner. Of course, half of you have been. But yes, for the time being, good night, everyone, and thank you.